Stock market's raging, and the traders all shout. There's one man we're watching, his moves full of clout. Some call him evil, some call him foul, but I just smile and call him Daddy Powell. Will Jerome Powell nuke the market again? With a flick of his wrist, make fortunes disappear in the wind. Wall Street's a jungle, lions on the prowl, but the king of the jungle is old Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down. The numbers are flying, red, ink, and green. For some it's a nightmare, for others a dream. Degens are crying, theories disavow, all bending the knee to mighty Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down. The bulls and the bears are locked in a fight. Who knows if we'll feast or starve come the night? With a glance at the screen, I let out a howl when I see that old motherfucker, old Daddy Powell. Oh, Daddy Powell, oh, Daddy Powell. Every single time, it's like a fucking roller coaster ride. It's gonna be a crazy week, so hold on tight. Oh, Daddy Powell, don't bring me down.
Oh, brother, oh, brother, oh, brother. Welcome back to a specialty episode of the Matt Kohrs Show. Come on down, where we're going to find out if we're making money or if we're going to be poor. The FOMC interest rate decision is about to happen at 2 p.m., so in about 12 minutes if you're watching this in real time. And then we're going to be hearing from Jerome Powell, the chairman of the Fed, a.k.a. the man with his hand on top of the money printer, a.k.a. the man who is going to make you leap with joy or cry with misery, a.k.a. Mr. Daddy Powell, will be speaking at 2:30 p.m., and that's where things are going to get really, really saucy. Obviously, today's going to be pretty crazy, so I highly recommend you quickly, rapidly, as fast as fucking possible, folks, put on some safety gear because you do not want to catch shrapnel. You 100% do not want to catch any shrapnel in this particular situation. So please get ready. Eye protection, head protection, ear protection, whatever you need. But we ain't fucking around here. This one's going to be a wild one. So please be careful. I'm going to turn this over so you can see what's going on in the market right now. Jerome Powell will be, the interest rate decision comes out at 2 p.m. in 10 minutes, and then we actually hear from Jerome Powell at 2:30. So that's going to be in about 40 minutes. Wait, what is this one? All right. Just getting some craziness. I'm talking to some quant buddies about what they're seeing in the VIX, and they're like, "Ooh, it's definitely picking up." Right now, we saw some bullishness this morning, then some bearishness, some bullishness coming back. Might be a weird shoulder head shoulder, but in reality, this price action doesn't matter. Folks, I'm going to tell you right now, I'm going to be honest with you right now. The price action before the 2 p.m. announcement, it doesn't matter. What matters is what happens right after 2 p.m. and then what matters from 2 to 2:30 and then 2:30 onward. So like I said in this morning show, what matters is the fact that today's 3 different independent trading sessions from 9:30 to 2, 2 to 2:30, and 2:30 to 4. That's what matters. So, of course, I have marked out the recent highs, the recent lows. We are giving back quite a few of these gains, maybe double bottom here on the Qs. We kind of overshot here on the SPY. I see the VIX is picking up off its low of almost below 20. Bitcoin was at 85, dropping down to 84. Interesting. We're gonna, you know what? I also want to let you know, this was a great question that we got from early on. Today is going to be an SEP day. We're going to get the summary of economic projections. You could check it out yourself, federalreserve.gov/monetary policy. And you can see it's going to populate right where my cursor is. So we're going to get the dot plot, and that's going to be massively important because we're going to get an understanding of where they see things coming. So we're going to get the updated viewpoint of inflation, GDP, unemployment, and obviously depending on the number, going up or going down might be pretty crazy. So right away, we're probably going to get more movement than anticipated at 2 p.m. And then at 2:30, we're going to get a lot of conversation from Jerome Powell related to what is happening with the balance sheet. What in the world is happening with the runoff effectively? What's happening with treasuries, mortgage-backed securities? Are they going to pause it? Are they going to stop it? Are they feeling comfortable with the current pace? But really, it all comes back to what's on the balance sheet, what's going on with reserves, especially as we're heading into a time roughly around August where the debt limit is going to most likely have to be raised again. What does it mean for the overnight lending market? I know it gets a little bit boring because it's in the world of fixed income, bonds, and yields and all that good stuff, but it does have a huge implication. The last time we had to legitimately deal with this being a problem was circa 2019. And the only reason it didn't become a larger problem was because Rona happened in 2020. And then they were able just to do as much purchasing as they wanted, all this quantitative easing. So they went from trying to run off their balance sheet to the exact opposite and intentionally balloon their balance sheet. So they figured, oh, okay, like we'll do that. And maybe in the meantime, we'll figure out how to solve it this time around. And it just didn't. It just did not. So absolute craziness. And I just wanted to kind of lay it out of what to expect. So right away at 2 p.m. when it comes out, we're going to be listening to the commentary on it. I'll be doing my quick little breakdown. And then we're going to have a little bit of time to kill. And then Jerome Powell will be going live at 2:30. And then that's where pandemonium is really going to happen. How are you feeling? I'm going to put up a poll right now. I want to know if you guys think today is going to end up being bullish or bearish. I know what my thoughts are, but I don't want to, I guess, sway anyone else's opinions before I see the votes. I just threw up the poll, so if you haven't already, let me know. How are you feeling? Are you feeling bullish? Are you feeling bearish? You got to vote, and you got to do it before 2 because it doesn't count. It doesn't count if you already know which way we're going. So I'm just curious how good you guys are at predicting. Now, if this does help you at all, obviously, here's a look at the SPY, the Qs, Vol is also picking up. Bitcoin's taking a little bit of a downturn. Here's a look at the options flow if you want to see the specifics. We have calls holding pretty constant, puts holding pretty constant, but puts were clearly being purchased ever since 11:45, while the calls were more so flat. Looking at the Mag 7 specifically, the delta trending down a little bit, but overall to the upside. You can see calls are being sold off, while puts have been very, very constant ever since about 11:45. So that's a quick little cheat sheet of what's going on between the Mag 7 and the SPY. So we're going to look at that. I also want to quickly look into one thing for you because this might be helpful. It's always useful to know where the big money's going before big events such as this. The average put strike being played is trending up. The average call strike being played is trending down. So that's actually pretty indecisive from the options market, which is kind of representative from the overall options flow that we are currently seeing. So interesting. The market is not making up its mind. So that's where we're at. I do implore you to vote. I want to see how it is. I want to see how it's going. I want to see how good you guys are at predicting. Oh, while we're waiting, I know this is very annoying to remind all of you, but folks, just because it's the start of the stream, if you guys could smash the like button, just because this is a specialty show. So if you could like, subscribe, turn on your notifications, that type of engagement basically tells the algorithm on both Rumble and on YouTube to serve this video to other people who might be interested. So I really don't ask much of you, but I would truly appreciate it if you could help me out on that side of things. Smash the like button. Don't forget to subscribe. And hey, say hi to your neighbor in chat because all that engagement, it really, really does assist. So thank you. Means the world to me. A couple more votes coming in bearish than bullish right now. I'm going to let it run for maybe up until 158. I'm going to let this run till about 158. And then I want to see how you guys really set this up. Option structure is bullish, however, so it can go either way. The option structure is not bullish. If you look at the options chain right now, it's put dominated with negative gamma. I don't know who's telling you that it's a bullish option structure, but it is not. There's been a little bit of a sway today from being put dominated to call dominated, but it's more so people selling calls, which really isn't that bullish. I don't know who's telling you that the option structure is bull dominated right now, but they're not giving you the accurate information. They're not telling you how it is. And just to make sure, I was double checking right before. So unless something has switched in like the past 5 minutes, there was a sway from what's being traded the most from puts to calls on the 0DT, but it is sold calls. It is not purchase calls. Super bullish on Matt's relationship advice. I don't know about that one. That one might be a guaranteed losing bet. Bullish maybe today and then fall off tomorrow, Friday. That's my uneducated guess. Those are the best types of guesses, man. I'm telling you, all you have to do is really put on your safety gear and you're going to be fine. Told you to sell calls. I wouldn't be selling premium on a day like today. Selling premium puts our insurance on longs. Are you just defining what a put is? You could also sell puts. You know that, right? Day trading with Matt, I think you might want to hit the books a little bit more and make sure you're really comfortable with what you're talking about here. You're kind of besmirching a high quality name within the trading space. Puts our insurance on longs. Maybe if you have longs and if you're playing it, it doesn't have to be insurance. Like what? That's literally the most textbook definition of puts of like, yeah. It is your right to sell stocks at this value. It's insurance. Yeah. Okay. Highly recommend diving into a little bit more of the study and the research on that one there, bucko. Matt, what's your prediction? I'm going to hold off on my prediction. My bias is bearish because I'm coming into this already with puts that I've been swinging for a while. So I want it to break down because I've had puts. It's not a 0DT trade. I've been in them for a couple days. I'm going to hold them for a couple days after this. I would obviously feel much more comfortable if we just go down because there's less pressure. So my bias is bearish, but for me to have a legitimate prediction, I just want to see the options flow. All right, I'm ending the poll because we have not much time left. We actually don't have much time at all. We have 90 seconds. And who won the vote? 55% said bearish, 44% said bullish. So we have a little bit more bears in chat right now. a couple more bears in chat. Interesting. All right, I guess we got some negative Nancys, if you will. All right, where are we at? I have this. As soon as it updates, we'll be able to see it. Let me put on, let's get up both Bloomberg and CNBC. This is going to be a wild one. All right, do we have the audio? We do have the audio.
Economy alive. It's
all right. They're talking about
GDP.
Consumption.
If they really start to deteriorate,
when all we want to know is what the hell are we doing?
If they have reason
all right.
to do that,
we have a 55-45 split in chat. 55% of you said bearish. 45% of you said bullish. So a little bit more red, a little bit more negative Nancy's. We're about to not only get the interest rate decision, where I can already tell you we're not getting an interest rate change. We're going to stay at 4.25%. But what's going to be interesting is breaking down the plot chart, the dot plot to see how they're changing their votes and what they think about inflation, unemployment, and actually various other measures. So as soon as it loads, we're going to see it here. But first, we're going to see a crazy reaction because the bots are going to parse this news rapidly. So let's go. We're going in 5, 4, 3, 2, 1. Boom. Down. Initial move down. We dropped 4 points. Back up. We went down to up. We're right at that resistance of 56.50. So first couple, that was weird. It was like awkwardly delayed. Then it pushed. And what this isn't people trading. This isn't bots going nuts or anything. This is bots going nuts. This isn't humans saying, oh, like I'm long, I'm short. This is exclusively bots trading, what they're attempting to do is parse apart this information right here. It's all this natural language processing, text processing. They go through all this in milliseconds and then convert their sentiment of what this is or isn't saying right into actual trade. So off right here, this I know it's like, I don't know, a little confusing because there's like a shitload of numbers, but what you need to know is right here. Last time they were expecting the December projection. So the bottom number, is what they thought last time around. And right here, they think GDP is going to drop down from 2.1 to 1.7. They're expecting unemployment to go up from 4.3 to 4.4. They are looking for inflation to now go up from 2.5 to 2.7. And they are looking for core inflation to go up from 2.5 to 2.8. And they are now just keeping the Fed fund rate constant. So actually, we're on pace for 2 rate cuts by 2026. So we're expected to go down from basically 4 to about 3.5. So we're now looking for, between now and the end of 2026, 2 rate cuts with 2 more coming in by the end of 2027. So getting between 3 and 3.5. So by the end of this year, they're still confident at 3.75. That's what this number means, because they're always the 25 bip ranges. So last time around in the December meeting, they said, okay, we think we're going to go to 3.75. They now still think they're going to 3.75. By the end of 2026, they are looking to go to 3.25, same thing. And so these haven't changed. Everything else got a bit more updated. So the Fed fund projection of like the actual Fed fund rate, that's the only one that remained unchanged. They are expecting inflation to go up this year. They are expecting core inflation to go up this year. They're expecting unemployment to go up this year. And they are expecting a GDP to drop. So I kind of understand why the market at first reacted in a bearish way, because that's not good. GDP down, unemployment up, inflation up, and keeping the Fed fund rate constant. I see why the initial reaction was down. I'm not really sure what part of this they are coming in at. So most of the we had 8 different FOMC members stay above this. Wow. So 4 of the voting FOMC members, this is the dot plot that I was talking about, 4 of them actually think we're going to stay at 4.25 this year. 4 of them believe that we're going to drop it by 1 rate cut. Most of them, 9 of them believe that we're going to come down to 3.75, and 2 of them believe we're going to come down to 3.5. It's interesting that 4 of these are like, dude, we are not getting any rate cuts this year. That is surprising to me, given that the market is now up. That is actually very, very, very surprising to me. Oops, wrong page. I don't know why the market is interpreting this to be bullish, because anyone looking at that would say that's not good. Inflation up, unemployment up. Some members are saying no cuts whatsoever. This is crazy. Let's see what lamestream media has to say about it.
But they're letting it run off, so the market's not freaking. Sorry for the interruption.
Well, I guess point being, and maybe one of our guests can step in. David Kelly, I'd be curious for your reaction on this, but if the Fed is slowing the runoff, on the margin, that's what I'm looking
They are
at bond
slowing the
yields
runoff.
falling right now. Is this welcome news for a treasury market where every little bit that helps in terms of people keeping the treasuries that they have and not reducing their balance sheet more as the Fed's doing here, does that really help on the margin with interest rates as we watch the 10-year moving to the downside?
Well, very marginally. This actually wasn't unexpected. The problem, they've got some multiple areas of uncertainty here, and one of them has to do with the debt ceiling. So they think there's going to be a debt ceiling agreement at some stage over the summer. When that happens, the Treasury is going to bounce up or increase its holdings of the Federal Reserve, which will cut reserves. It brings the idea of a problem in the Treasury market more, or in short-term interest rates more likely, and that's what they've been trying to avoid. They want to be sure that they don't have a repeat of what they had back in 2018, where they let reserves get down too low.
Yes.
Now they see a risk of that in the next few months, and that's why they are just backing off here. They just don't want to reduce that balance sheet too much and end up with a problem. So just trying to keep
This is exactly what we were talking about. What are they doing with their balance sheet?
David, I only want to harp on this because Steve just said there were some hawkish elements. So if people are wondering, well, why would that not translate to bond yields going?
This is very important. Beginning in April, the committee will slow the pace of decline of its security holdings by reducing the monthly redemption cap on the treasuries from $25 billion to $5 billion. Jesus. The committee will maintain the monthly redemption cap on agency debt and agency-backed securities at $35 billion. So basically, they are really dramatically slowing down the pace of their balance sheet runoff because they're worried about what the lowered reserves will do to the overnight lending, which has caused havoc in the past. The committee is strongly committed to supporting maximum employment and returning inflation to its 2% objective. I really, really don't see what this makes more sense to me. I don't see why it went bullish. I mean, I get that I'm just a dumb fuck, but I'm not seeing a bullish aspect of this decision. They see inflation going up, employment going up, they see GDP dropping, and things are so bad in the underbelly of the market that they have to slow down their balance sheet runoff because they're so worried about what's going to be happening with bank reserves. And the market popped on that? What the fuck, dude?
What a reserve does, they simply want their own borrowing costs, mortgage rates, auto rates, credit card rates, whatever it may be, to come down as well. How do you read this running off, not selling of treasuries?
Yeah, and that's been the case throughout, most of this QT period. Now they're just slowing down the pace of that, which makes sense, right? As David highlighted, there's concern around the debt ceiling that could create a lot of volatility within reserves. They're just trying to get ahead of it. This was a fairly modest move, and it was hinted in the minutes. So while this is slightly, a slight surprise, it was not overly surprising for the market, but this is the one difference versus what forecasters had effectively priced in, which was the change in growth, change in inflation, and expectation that they could stay pat on rates at this point because we don't really know the full effect of policy. April 2nd is going to be a really telling deadline in terms of what Trump's going to do from a tariff perspective.
Yeah, sorry, Jim. Let's go very quickly through just kind of the people are just joining us here. Oh, my gosh, the Federal Reserve, they jump in. Here's, I think, how we're reading this. And again, Steve Leisman, please jump in if any of this is not correct. By the way, markets there are not moving or moving slightly higher. Maybe on this news we shall see. The Fed sees the economy expanding. Maybe 2 rate cuts seen this year. No real change in the job market the rest of the year. Maybe a slight, I think Steve Leisman said 0.1% drop in the jobless rate so far this year. Inflation maybe mildly higher as well. So, Jim, how do you read what the Federal Reserve just did?
I think this is very non-committal. The Fed is kicking the tires on the economy. Look, we have a couple of things in front of us, and I think it's very important to respect the timeline. We've got reciprocal tariffs coming up on April 2nd. We don't really know how that's going to go, but it's in front of us. Then you have first quarter earnings results that are going to come out. CEOs are not going to sing a positive tune about the first quarter, right? You're likely to see some basically some bad news from some of the CEOs, or at least talking that way. The next Fed meeting is May 7th, and I think that tees us up for a rate cut at the June 18th Fed meeting. So essentially, this is the first time the Fed is trying to make a decision as financial conditions are tightening, meaning that credit spreads are widening and the equity market has just gone through a 10% drawdown. So effectively, this is the first time the Fed is trying to decide, as markets are now starting to soften and weaken, what they ought to do. And in the past, you had a stronger equity market, tight credit spreads, and the Fed was trying to convince you that cutting interest rates was the right thing to do. Now, the markets are kind of siding that way, but they're not 100% sure how this is all going to play out. April data, the events of April, I can't underscore this enough, are going to be extremely important, and I think the tone is going to be changed by May 7th at the next meeting.
Steve, we know that the market's first interpretation is often not its final one. Going back as we digest this, what kind of explain to us the hawkish element you see a little bit here in the statement and in the dots?
Okay, I'll go back to my notes here. It's a very technical thing. I wish I had a graphic I could put up. Maybe they have it up right there. Okay, so here's what happened. There's 4 now with no cuts for this year. That had been only, I want to double check what I'm saying here, had been only 2, okay? And then you see there's 2 with 3 cuts. There had been 5 with 3 cuts. So a compression towards the middle. Guys, I want to explain how maybe I look at this whole statement. I don't see the balance sheet as that big a deal. The bond market may get some help from that. To me, this is a bit like the Fed sending up a flare or an SOS and saying, we don't know what's going to happen. They reduced the growth rate pretty sharply. They raised the
right back at the top of the zone. Dude,
and kept
what is the market doing right now?
Unchanged. But more importantly to me is it removed that statement in the from the last statement that said, we think risks are roughly in balance. That's gone. I don't think they know where risks are going to go. And I think what they're doing, I think it was Jim who said it earlier, playing for time is where they're at right now because of the uncertainty. Look, they took this statement that said uncertainty has increased and put it up in like the second paragraph of the statement here. So this is almost waving a white flag on the outlook saying we surrender.
And
well,
the market's going up on that?
Stuff.
What are these
and
bots trading, dude?
This statement, Kelly, and the last statement.
That makes no sense to me.
I want to see what
they're actively admitting uncertainty is going up.
Because the two came
and
to
the
the
bots
exact same
bought that
conclusion.
up.
Sorry.
And Steve doesn't
What
require
the fuck?
nearly as
This
much
just shows you how
energy.
crazy the market is.
David Kelly, what's interesting about...
You don't know how much energy I require, Brian.
Well, today I know you might need a few extra caffeinated coffees. David, but here's the reality, and I think to waving the white flag point, April 2nd are when these new tariffs are supposed to kick in.
Wow.
They may not. They could kick in before. They could kick in never. They could kick in later.
Yeah,
We don't
calls
know.
being closed,
How
puts
much,
being purchased on the Mag 7,
doesn't
calls
matter,
being
but how much
purchased
do you
on
think
the
Federal Reserve
S&P
is like
500, but
everybody
the
else,
puts are kind of
just
flat
kind
down here on the
waiting and
S&P
seeing
500.
what this administration
That's
does,
nuts.
because how do they make any real policy moves when we don't actually know
It's bull
what's
structure,
going
bro.
to happen?
Definitely
exactly.
not.
2 days after the election, Jay Powell said, we don't guess, we don't speculate, and we don't assume. But you can't make monetary policy unless you do one of those things. And so eventually it's going to have to make a monetary policy move one way or the other. But I think it's not just the tariffs. The other part of it that's really important is how does this how does the tax bill for 2026 evolve over the next month or two? If we get one big bill which involves a lot of fiscal stimulus in 2026, then the Fed's going to look at that and say, why should we deliver monetary ease?
This feels like a bull trap.
If on the other side they're stimulating the economy also.
Is liking
and so they want to see that too. So I think it's
the
a bit about
balance sheet
tariffs,
is calming
but
down,
it's also
or
a
the
lot
balance
to do
sheet
with how
runoff is
Congress
coming down.
Shapes this tax bill for 2026 and what that
Doesn't
means for
make
the outlook
sense,
for
though.
2026.
You know how bad things have to be for them to do that?
It's signaling greater uncertainty, but they, like everybody else, just has to wait and see.
All right.
We're
Panel,
breaking out
thank
of
you.
the
We'll leave it
initial
there for the
range
time
here
being.
on
We
the
appreciate
SPY
it
and the
as the market
Qs.
moves back towards session highs. Dow's up 235 points. On that note, let's get down to Mike Santoli at the New York Stock Exchange. Mike, and what's your take?
Yeah, Kelly, I think the reason the market, I think, initially is able to have some measure of comfort with this outlook, to me, is in the raising of the inflation projection, PCE inflation to 2.8, and not reducing the median number of cuts. That, to me, suggests some level of tolerance for inflation being sticky. They still think policy is somewhat restrictive. They still think that disinflation is the reason that they would be normalizing rates lower from here. And they don't see a reason collectively at this point to change anything. Now, none of those positions is held with high conviction. And I think as everybody's been saying, they're essentially just going to defer to the next several weeks worth of facts and developments before we decide.
And the fun's not over. This is gearing up to be a wild speech right now.
You know, you realize that the Fed
Jerome Powell, if you're joining, he'll be speaking in 15 minutes.
Good news on the economy should be good news for the markets because, you know, you're not really wishing for things to erode quickly from here, I don't think, if you want earnings estimates to hold up.
Let's go now to Chicago, and a man I just saw in person, by the way, which
Calls
is great.
being
Rick
purchased,
Santelli. Okay, I need your help, Rick, because I'm very confused.
Our boy,
We're starting
Rick.
to see headlines crossing from other news organizations. Financial Times saying Federal Reserve sharply cuts U.S. growth forecast. Okay, maybe, but the first line of their statement
puts our flat.
Recent
Calls have been going up.
Economic activity
we just had this burst of call buying right at 2.
At a solid pace. I'm trying to figure out where some of these headlines are coming from. What are you seeing something different?
Yeah, most of the people I talk to that are traders or with large institutions, hedge funds, they don't really pay as much attention to these flashes as you're pointing out. As a matter of fact, with all this talk about uncertainty, here's what many people I talk to jokingly say. When we were pre-uncertain times, was the track record of the crystal ball of the Fed and their dot plots very accurate? No, it wasn't accurate pre-uncertainty. I don't suspect it's going to be any more accurate during uncertainty. Here's what many traders are talking about even before any of this happened. Okay, we're talking about any changes more or less, and that really is it. More, less. Okay, and I'll tell you what I mean. Downshift, less growth, but not recessionary. Less labor strength, but not recessionary. Less inflation progress, paying more attention now than they did, and less easing based on just general notions that they're going to remain pretty aloof because they really don't know what to do, and less QT. And all of those things I discussed with many of my sources long before this statement or the Fed meeting. These were from yesterday or the day before. And the reason I bring them up is that I think when we talk about balance sheet, first of all, that was completely built in. Actually, many expected that we wouldn't just get less QT, that we would actually end QT or do more quantitative easing. So I don't see much movement actually from that headline. But I think that when you look at it all together, what you see is exactly as our panel said, a Fed that doesn't want their fingerprints on the shit because they don't know what the future is, but they've never known what the future is. We just don't know how the globe is going to readjust to all the things that may come down the pipe. Maybe Liberation Day on April 2nd, we get no tariffs. But at the end of the day, keep two things in mind. Okay? That is, if the Fed doesn't do as much, short end is going to get sticky, and it has. Right now, twos are hovering right around unchanged. Matter of fact, most of the curves around unchanged. And the long end is going to be very disturbed that we're not going to get anywhere closer to the 2% target. And most likely, this administration isn't going to make huge progress on deficits. So if you had to summarize, once again, I think you're going to look for some curve steepening driven by long rates going higher.
Rick, when you say curve steepening, I remember those debates that we had about flattening being a bad thing. So is this moving in a more constructive direction here?
Well, I think it's a more constructive adjustment, in my opinion, because I think long rates divorcing themselves from some of the manipulative forces and being more susceptible to market forces is truly a good thing. And once again, I think that the equity markets now are showing you the true direction. Maybe there's not going to be any Fed put, so to speak, but don't kid yourself. The Fed pays very close attention to equities, and the more volatility they get in equities, the more uncertainty they're going to showcase in their statements.
Yep, that U word. Rick, thank you very much, Rick Santelli.
New
Let's
Delta high
Clarida,
on the Mag 7.
The former Fed Vice Chair, Global Economic Advisor at PIMCO. All right, Rich, what's your take? Welcome.
Well, you know, I think there was a lot of focus on would the dots remain unchanged, and so they still show the two cuts, albeit with a little bit more disagreement. I would point out the downshift on the growth projection is basically to the pace of growth the Fed thinks is consistent with trend or potential growth. But yes, they are emphasizing the uncertainty, and I'd expect the chair to say that in a couple of minutes at the press conference. And then finally, I think there was some speculation based on the January minutes that they might end QT entirely today. So essentially, they're saying they're going to cut back the pace of the runoff, but still do some runoff. So all in, I think a pretty constructive meeting compared to some of the concerns going in.
Market seems to be most happy that despite their upward revision to their core inflation forecast, they upped it by 0.3 because of tariffs. But they didn't change the fact that they still could do 2 cuts, right? So you're kind of getting that best possible. They're looking past the tariff impact there.
I think you're 100% right. You know, there's been an ongoing debate in the press, online, and I'm sure probably at the Fed about the best way to think about the Trump tariffs. And consistently, you know, what Chris Waller and Chair Powell and others have said, the first instance is to look through that as not inflationary. And I think today's signal from the dots is an indication
5 minute,
that
10
that's
minute,
their baseline.
30 minute,
They're gonna be
4 hour
attuned
turn
and
actually go
attentive to
bullish.
inflation.
5 minute,
And
10 minute, 30
if you
minute,
look,
all
they
bullish
indicate
for
that
maybe
there is
pushing.
upside risk to inflation from this forecast. So I
Man.
think that also explains
The market's just
some of the
loving
change
this
in the
idea of
language,
easing out
wording.
on the
There's a firm
quantitative
out
tightening.
by a big mall called Fashion Island in Newport Beach, California. They manage trillions of dollars. They're called PIMCO. You might have heard about them, Richard. And PIMCO's job is not to react to the Fed as much as it is to anticipate what the Fed, or what more importantly,
Slowing
the
the pace of its security
may do.
holding, and the market's
bond market,
liking
as
it.
I pointed out at the top of the show, may be saying something different than our friends at the Federal Reserve are, because borrowing costs have actually gone up, not down, even as they're talking about cutting interest rates. Where does PIMCO see borrowing costs 6 months and 1 year from now?
We had a big move up in Treasury yields, in the anticipation of the election, and then after the election, the so-called Trump trade.
We're holding right
So
above the
some of
high
the
from
moving yields
yesterday
really has
on
not
both
been
the
so
SPY
much
and the
about
Qs. We're
monetary
right at
policy,
it.
it's
Q
about,
slightly
the fiscal,
below, SPY slightly above.
outlook. You know, we've consistently said we think we're going to be in a world of a steeper yield curve. I noted that on your conversation a moment ago. You know, the 10-year Treasury yield has really been in a range of between 375 and 475, and that makes sense to us right now. You know, the big question is, when and how rapidly will the Fed cut, and that's going to be very data dependent. So I hate to disappoint you.
But Rich, my point was, does it matter? Listen, I'm not discounting the Fed. They run the show.
Yeah.
I get it. Okay, they're kind of like the referees. If you
Little
want to
call,
compare them to
dude.
March
The overall
Madness.
delta just
But
strong. Look at that.
They're talking about cuts.
A little
And
bit of
the
a give
bond
back
market
right
is
here,
going
but
in the
overall,
opposite direction. We have viewers and listeners that are thinking about buying a
SPY's
home,
taking a
and
bit
they're
of a bigger
waiting for
hit.
rates to come down, and they hear, "Ooh, the Fed's going to cut, honey. Don't worry, we'll wait a couple of months, and mortgage rates will come down."
Calls
Guess what?
turning a little
They've
bit.
waited,
Same with
and
puts.
mortgage rates
But overall,
have gone
it's just a
up,
slight turn.
not
I mean,
down, since the September
this is a better
18th
look at it.
Fed rate cut,
Just starting
where they
to
sort
get
of
dumped right
bizarrely
here,
sliced by 0.5%,
as we
and
had
talked
9
about,
minutes ago till
inflation
Jerome
being
Powell
somewhat
actually speaks.
elevated. That was in September, not now. How much do you trust?
Do you think they're
going to
be so dirty? Do you think that they're going to be so dirty to turn this whole thing? I can't. I mean, I guess I can, because we lived in the upside down for so long, where any bad economic news was actually bullish because of the idea of what the Fed would have to do. So what we just got was a lot of bad economic news. The Fed now believes inflation up, unemployment up, GDP down. That's all bad, but the market is seemingly interpreting it as good news, because it's not even an interpretation. We got it from the Fed themselves that they're going to calm down their quantitative tightening, their QT. So if they're calming that down, the market is clearly viewing it as a bit of a breather. But I mean, are we really back in that phase where bad economic news is good for the market and good economic news is bad for the market? Are we really going to be in that much of the upside down? Obviously, we got a bit of a move. At first, the move was down, but we actually didn't even take out the intraday low. It was just like this wick down. And then we kind of pumped, we held, we pulled a little back, then we pushed, and now we're just kind of stalling out at, surprise, surprise, the key levels we already saw this morning. Actually, just right here, this initial reaction down, then huge up, then it reverted. That made more sense to me. Then we got this big pump, came down, finding support at yesterday's high. This is why you should always mark these levels out. They end up being very important support, resistance, reactionary levels. We saw some profit taking at one point here. And now we have more calls coming back in, I believe. Yeah. Yep. A little bit more. Just got smacked again. If anything, it's flat. But at this point, there's probably, I wouldn't be slinging any positions right now because you might as well just wait the next 6 minutes and just wait for Jerome Powell to start speaking. Now, I want to be very clear. This pump right here, it could be like 3x, 5x by Powell. On the flip side, we've also been in situations where whatever this first move is, like clearly from 2 to 230, completely reverted and then some by Powell's speech. So there's not like a good rule of thumb to go on here in terms of like, okay, should you go with that first push or should you be reverting it? I could show you right now in real time many examples supporting the continuation, whether bullish or bearish, and many examples of Jerome Powell completely switching it, which is why there's the ongoing joke of just like Powell screws us all over. So with it, truly the math of the situation is saying from here to the end of the day, it's still pretty much 50-50. You don't have clear sentiment. Maybe the edge, I would say, gets a little bit more favored for the bulls because the delta is still holding. That's the green and the purple lines here. Just there is positive momentum in the options market on the 0 DTE. On the all expiration, it's still pretty put dominated, which is maybe, I guess, an argument that maybe we get faded later. But I mean, I could double check just to make sure. But I mean, the last time I checked, which was right before the announcement came out, we had a massive put domination for the monthly, quarterly quadruple witching this Friday. Is it being faded a little bit? No, not really. Not really. Look at that. This is all the action we've gotten since it came out. Pop, pullback, big pop, sideways movement. Yeah, right now the entire options chain is put dominated. We have today is now slightly call dominated. Today's 0 DTE is now, after this push, call dominated. Tomorrow is it's pretty much neutral, slightly call dominated. And then you look over at Friday and it's massively put dominated by the time you go to the 21st, which is probably from here now the most important daily expiration, just because it is the quadruple witching for the 21st. And then just to check the 31st and the 28th. So Friday and then the next Monday, the 28th and the 31st are still put dominated. Just paying attention to the last day of the month and also looking at the last day, well, really looking at the JP Morgan position on the 28th. But a lot of negative gamma and definitely put dominated for later on. Today, slightly call dominated, and tomorrow, pretty much neutral, but technically, as of right now, there is a little bit of positive gamma. But I just want to let you guys know the party's not over today. We could easily rip and go way past this intraday high to the tune of, I mean, honestly, it wouldn't be that crazy for us to go all the way up to 5,700 today. Totally possible. On the other side, we could easily crack 5,600, which would be all the way down here. So I'm kind of watching those important 50 point rungs with a big pivot point right here at 5650. Obviously, we're on top of it. We popped above it, came down, recaptured it, chilling on the top side. This 5650, it is yesterday's high. It is a massive open interest level. So watch this midpoint as a pivot. Are we above or below? And obviously, throughout the speech, we're going to try to see if we can see what in the world is going on with the options market as he's talking. The options market is starting to fade as we're getting a little bit closer to his talk. It might just be the sentiment of people, hey, they had calls, they might just want to lock in their profits. Like, why take the risk of his speech? That could be it. But obviously, time will tell. Time will tell. I marked up a potential reversal. On the SPY, it would be 564.58, and on the Qs, it would be 478.54. So watch those for a potential downside reversal. But to be very clear, we are much closer to the intraday high than we are the low, and vol is taking a hit. It's trying to hold 20, but vol has clearly been trending down here. So buckle up, Buttercup, because we are in for quite a ride. Quite a ride, quite a ride, quite a ride. All right, let me just make sure that I have this ready to go. Where in the world is it? All right. I don't think you guys can see it quite yet. All right, there we go. You guys probably can't hear it, and I can't hear it either. Hang on, let me turn that off. Are they playing? They love playing horrible elevator music. They love playing horrible elevator music. Just a test of our resolve. All right, let me just turn off the elevator music. We don't need to be subjected to that at the moment. But okay, Jerome Powell speaking in 1 minute and 20 seconds. So congratulations to the 45% of you that first voted bullish on the initial reaction. And now we are going to have you guys vote on what do you think is coming from Jerome Powell. God, these people. Structure 84% of market cap, now 84%. Bullish gamma now was 66. There's no such thing as bullish gamma. That's so fucking dumb. Oh, there's nothing more painful than people who try to cosplay as knowing what the market's about. Gamma is not a bullish or a bearish thing. It is telling you about market makers hedging. God. Structure 84% of S&P market cap, bullish gamma now. You know how I know you don't know what the fuck you're talking about? Because you don't know that there's no such thing as bullish gamma. Gamma is not a bullish or bearish thing. It tells you about how market makers are going to hedge in various situations. You can't have bullish or bearish gamma. There's no such thing as bullish or bearish gamma. You're just dumb, dude. You're really, really ruining a good name. Really, really don't know what you're talking about. I hope you don't teach people, man. I hope you don't teach people. All right, are we going to get rocking here? Is he talking? Is he taking the stage? Oops. Hello? Hello?
Good afternoon.
Whoa.
My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people.
All right, this one's way too quiet. Let me see if I can find another.
We've made significant progress toward our goals over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2% longer run goal, though it remains somewhat elevated. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We also made the technical decision to slow the pace of decline in the size of our balance sheet. I'll have more to say about these decisions after briefly reviewing our economic developments. Goals of maximum employment, stable economic prices, activity continue to benefit of the American people. The economy is strong overall and has made significant progress
he's just talking real soft
over the past 2 years. Labor market conditions are solid, and inflation has moved closer to our 2%. Households and businesses point to heightened uncertainty about the economic outlook. It remains to be seen how these developments might affect future spending and investment. In our summary of economic projections, the median participant projects GDP to rise 1.7% this year, somewhat lower than projected in December, and to rise a bit below 2% over the next 2 years. In the labor market, conditions remain solid. Payroll job gains averaged 200,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and is held in a narrow range for the past year. The jobs to workers gap has held steady for several months. Wages are growing faster than inflation and at a more sustainable pace than earlier in the pandemic recovery. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance. The labor market is not a source of significant inflationary pressures. The median projection for
new intraday high in the SPY and the keys while the VIX is falling.
At the end of this year and 4.3% over the next 2 years. Inflation has eased significantly over the past 2 years, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in February, and that excluding the volatile food and energy categories, core PCE prices rose 2.8%. Some near-term measures of inflation expectations have recently moved up. We see this in both market and survey-based
price pump,
measures.
new delta high.
Survey respondents, both consumers and businesses, are mentioning tariffs as a driving factor.
SPY's going up almost a
Beyond the
new
next
delta
year or
high.
so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. The median projection in the SEP for total PCE inflation is 2.7% this year and 2.2% next year, a little higher than projected in December. In 2027, the median projection is at our 2% objective. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%. Looking ahead, the new administration is in the process of implementing significant policy changes in 4 distinct areas: trade, immigration, fiscal policy, and regulation. It is the net effect of these policy changes that will matter for the economy and for the path of monetary policy. While there have been recent developments in some of these areas, especially trade policy, uncertainty around the changes and their effects on the economic outlook is high. As we parse the incoming information, we're focused on separating the signal from the noise as the outlook evolves. As we say in our statement, in considering the extent and timing of additional adjustments to the target range for the federal funds rate, the committee will assess incoming data, the evolving outlook, and the balance of risks. We do not need to be in a hurry to adjust our policy stance, and we are well positioned to wait for greater clarity. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. An admittedly challenging exercise at this time in light of considerable uncertainty. The median participant projects that the appropriate level of the federal funds rate will be 3.9% at the end of this year and 3.4% at the end of next year, unchanged from December. While these individual forecasts are always subject to uncertainty, as I noted, uncertainty today is unusually elevated. And of course, these projections are not a committee plan or a decision. Policy is not on a preset course. As the economy evolves, we will adjust our policy stance in a manner that best promotes our maximum employment and price stability goals. If the economy remains strong and inflation does not continue to move sustainably toward 2%, we can maintain policy restraint for longer. If the labor market were to weaken unexpectedly or inflation were to fall more quickly than anticipated, we can ease policy accordingly. Our current policy stance is well positioned to deal with the risks and uncertainties that we face in pursuing both sides of our dual mandate. At today's meeting, we also decided to slow the pace of decline in our balance sheet. Since we began balance sheet runoff, our securities holdings have declined by more than $2 trillion. While market indicators continue to suggest that the quantity of reserves remains abundant, we have seen some signs of increased tightness in money markets. Beginning in April, the monthly cap on Treasury redemptions will be lowered from $25 billion to $5 billion.
None of this is new, by the way.
Consistent
This
with
is all the
committee's
information we
intention
already
to hold
knew.
primarily Treasury securities in the longer run, we are leaving the cap on agency securities unchanged. This action has no implications for our intended stance of monetary policy and should not affect the size of our balance sheet.
Is this a market reversal? I don't think so.
The committee also
I think we have
continued
to
its
very much
discussions
wait
as
for
part of
quad
our
witching to
5-year
play
review
out
of
and
our
all of
monetary
those
policy
options to be
framework. At this meeting,
restructured.
we focused on labor market dynamics and our maximum employment goal. As we have indicated, our review will include outreach and public events involving a wide range of parties, including Fed Listens events around the country and a research conference in May.
This is the overall picture.
Throughout this process, we
You
will be
can't
open to
call
new
this
ideas
a
and critical
reversal.
feedback, and
We
will
haven't.
take on
We took
board
out
lessons of the
only
last 5
the
years
high from
to
yesterday. We haven't
determine
even
our
taken out the
focus.
high from the week
We
after this
intend to
huge
wrap up the
sell-off.
review by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans.
Oh, shut
We
up.
understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I will look forward to your questions.
Howard Schneider with Reuters. Thanks for your time. So 2 things on sort of the real side here, inflation and then GDP. how much of the higher inflation forecast for this year is due to tariffs? And since the policy path remains the same, are you effectively reading this as a one-time price level shock?
Okay, so how much of it is tariff? So let me say that it is going to be very difficult to have a precise assessment of how much of inflation is coming from tariffs and from other, and that's already the case. You may have seen that goods inflation moved up pretty significantly in the first 2 months of the year. Trying to track that back to actual tariff increases, given what was tariffed and what was not, very, very challenging. So some of it, the answer is clearly some of it. A good part of it is coming from tariffs, but we'll be working, and so will other forecasters, to try to find the best possible way to separate non-tariff inflation from tariff inflation. In terms of your sort of looking through question, too soon to say about that. As I've mentioned, it can be the case that it's appropriate sometimes to look through inflation if it's going to go away quickly without action by us, if it's transitory. And that can be the case in the case of tariff inflation. I think that would depend on the tariff inflation moving through fairly quickly, and it would depend critically as well on inflation expectations being well anchored, longer term inflation expectations being well anchored.
Well, I guess I'm looking at the out years here, and the fact that the policy path doesn't change at all, and inflation is unchanged in the out years also. Doesn't that imply you all have basically decided that there is no signal here, and that it's just we're back to transitory again?
So I think that's kind of the base case, but as I said, we really can't know that. We're going to have to see how things actually work out. And the fact that there wasn't much change, I think that's partly
this is
because
right when the first announcement came out.
Weaker growth but higher inflation.
So since then, up a good
also, frankly, a little
45
bit of inertia.
points.
When it comes to changing something in this highly uncertain environment, I think there is a level of inertia where you just say, maybe I'll stay where I am.
Yeah.
Thank you, Colby Smith with the New York Times.
Actually, just under 40, we went up.
Expectations as well.
Coming down a little bit now, about 10, but overall, still in the green since the announcement.
Of uncertainty expressed by businesses, households, and forecasters.
So on inflation expectations, of course, we do monitor inflation expectations very, very carefully. Basically, every source we can find.
23 now.
Short-term, long-term, households, businesses, forecasters, market-based. And I think the picture broadly is this. You do see increases widely in short-term inflation expectations. And people who fill out surveys and answer questionnaires are pointing to tariffs about that. If you look in the survey world, if you look a little further
calls
out,
are being sold a little bit, but so are puts.
You don't see much in the way of an increase. Longer-term inflation
calls are
expectations
zero
mostly
DT
well
calls are being sold, and now zero DT puts are being purchased
then
on the
you have
SPY.
market-based, and
That's
it's the same
interesting.
pattern. People in markets are pricing in break-evens. Some higher inflation over the next year must be related to tariffs. We know from the surveys. But if you look out 5
huge
years
pop.
or 5 year forward, you'll see that break-evens are either flat or actually slightly down in the case of the longer term.
Not that
so
far off
we
from
look
the
at that,
intraday
and
high.
We will be watching all of it very, very carefully. We do not take anything for granted. It's at the very heart of our framework, anchored inflation expectations, but that's what you see right now.
And how much weight do you put on the deterioration in consumer confidence surveys? You said recently that this is perhaps not the best indication of future spending, but I'm curious, what you think is behind this deterioration and to what extent it could be a leading indicator for hard data.
Heading towards the intraday high.
Let's start with the hard data. We do see pretty
VIX
solid
coming
hard
down.
data still. So growth
Bullish,
looks
bullish,
like
bullish,
it's maybe
bullish,
moderating
bullish,
a bit,
bullish.
consumer spending moderating a bit, but still at a solid pace. Unemployment's 4.1%. Job creation most recently has been at a healthy level. Inflation has started to move up now, we think partly in response to tariffs, and there may be a delay in further progress over the course of this year. So that's the hard data. Overall, it's a solid picture. The survey data, both household and businesses, show significant rise in uncertainty and significant concerns about downside risks. So how do we think about that? And that is the question. As I mentioned the other day, as you pointed out, the relationship between survey data and actual economic activity hasn't been very tight. There have been plenty of times where people are saying very downbeat things about the economy and then going out and buying a new car. But we don't know that will be the case here. We will be watching very carefully for signs of weakness in the real data. Of course we will. But given where we are, we think our policy's in a good place to react to what comes, and we think that the right thing to do is to wait here for greater clarity about what the economy is doing.
Nick Timmeros, The Wall Street Journal.
Here we go, Nick.
Chair Powell, Chair Greenspan once defined price stability as an environment
New intraday high on the SPY and the Qs.
over time, that it doesn't materially enter into the decisions of households and firms. Can you say that today, that we have that price?
Give Nick the mic back.
Businesses are ignoring price growth when you see buy in advance psychology, big changes in inventories, and surveys that show consumers, at least in the short run, expect higher inflation.
So I do like that definition a lot. In fact, I used it at the recent conference where I spoke. So I think a world where people can make their daily economic
More calls
decisions
being
in businesses
purchased.
and they're not having to think about the possibility of significantly high inflation. We know inflation will bounce around. That is price
VIX
stability.
coming down.
I think we were getting closer and
Bitcoin
closer
chilling
to
at
that.
84.
I wouldn't say we were at that. Inflation
Tesla
was
picking
running
up a
around
little.
2.5% for some
Nvidia
time.
intraday high.
I do think with the
Tied
arrival
intraday high.
of the tariff inflation, further progress may be delayed. The SEP doesn't really show further downward progress on inflation this year, and that's really due to the tariffs coming in. So delayed, but if you look at our forecasts, we do see ourselves getting back into the low twos in 26 and then down to 2 by 27, of course, highly uncertain. So I see progress having been made toward that, and then progress in the future. I think that progress is probably delayed for the time being.
If that's the case, why are there cuts in the SEP for 2025?
So again, people wrote down 2 cuts the last time, and they look at the they wrote down meaningful decline in growth from 2.1 to 1.7 in 2025, a tick up in the unemployment rate, so not much there, but core inflation up by 0.3, and so those kind of balance each other out. So people, not everybody, but on balance, people wrote down similar numbers. The changes aren't that big. The other factor, though, as I mentioned, is just really high uncertainty. What would you write down? I mean, it's really hard to know how this is going to work out. And again, we think our
What
policies
would you
are in
write
place.
down?
We think it's a good place.
Not
where we
the
can
best
move
answer
in the
there,
direction
buddy.
where we need to, but in the meantime, it's really appropriate to wait for further clarity. And of course, the costs of doing that, given that the economy is still solid, are very low.
Thank you, Mr. Chairman. Edward Lawrence with Fox Business. So with near 4% unemployment rate, that should be low enough to bring people in from the sidelines in terms of hiring. But we're seeing the hiring rates have been stuck at 2023, 2024 levels. So what's going on there?
Yeah, so that's a feature has been for some time a feature of this labor market. You have pretty high participation accounting for aging. You've got wages that are consistent with 2% inflation, assuming that we're going to keep getting relatively high productivity. We've got unemployment, pretty close to its natural level. But the hiring rate is quite low, but so is the layoff rate.
Big pump, pullback, big pump, pullback. Is there going to be another big pump following
losing
this?
Their jobs, but you're seeing that people who don't have a job having to wait longer and longer. And, the question is, which way does that break? If we were to see a meaningful increase in layoffs, then that would probably translate fairly quickly into unemployment, because people are, it's not a big hiring market. We've been watching that, and it's just not in the data. It hasn't happened. What we've had is a low firing, low hiring situation, and it seems to be in balance now for the last 6, 7, 8 months. That's where we are. There's healthy levels of job creation too. So overall, it's a labor market that's in balance, and we watch it very carefully.
So then, have we seen the new administration's policies in the economic numbers yet? And when do you anticipate that happening?
In labor or in other?
In labor and inflation, just across the economy, have we started to see the new policies
Coming back
take
up for the
effect?
intraday high, just higher highs, higher
only
lows.
kind of an early
Right here is the highs,
only
here's
in
the
a few
lows.
months, right? You know, for example, the layoffs that are happening here are, you know, they're certainly meaningful to the people involved, and they may be meaningful to a particular neighborhood or region or area, but at the national level, they're not significant yet. But we don't know. We don't know how far that will go. We'll find out much more. I mentioned that you saw we've had two very strong goods inflation readings in the last 2 months, which is very unexpected.
Mag
I
7
think
Delta
hard
calls
to
at the
trace into
highest it's
specific
been
tariffs,
today.
but it must have something to do with, it's either noise and it'll come back, and that's
Same
very
thing with the
possible too,
SPY.
but if it is persistent, then it must be to do
Longer
with,
duration calls are at their
people
max
buying
value,
ahead
but
of tariffs
puts
or
are
raising
almost at
prices
their
ahead of
max
tariffs and
value.
things
So
like that. Those kinds of things
that's
happen. They're
crazy.
very, very hard to capture.
Clearly the
because someone
calls
said,
are winning that one.
A great example is their washing machines were tariffed in the last round of tariffs, and prices went up. But prices also went up on dryers, which were not tariffed. So the manufacturers just, you know, they just kind of followed the crowd and raised it. So things happen very indirectly, and so there'll be a lot of work done in coming months to try to trace all that through. But ultimately, though, it's too soon to be seeing significant effects in economic data.
Craig Torres from Bloomberg News. Thanks, Chair Powell. You said transitory price increases from tariffs are the base case. Transitory is the base case. Wasn't it the base case last time? And didn't the FOMC forecast lower inflation ahead last time? And wasn't the lesson that it quickly got into services, haircuts, daycare, everything else? And so I'm just wondering why the 9 aren't taking that on board and are cutting twice this year.
When you say last time, are you talking about the last
pandemic? Yes, during the
because
pandemic.
you could have been talking about the last time there were tariffs, in which case the inflation was transitory. Yeah, no, of course we're well aware of that, and you know, it's still the truth. If there's an inflationary impulse that's going to go away on its own, it's not the right policy to tighten policy. Because by the time you're
right
in
at
effect,
this
you're,
new
you're
high.
in effect by
I think if this
design,
pops and goes,
you are lowering economic
legitimately talking
activity.
about 5,700.
That's not necessary. You don't
But
want to do
that's
it.
a
In real
big
time,
if.
as we know, it's hard to make that judgment. So, and we're well aware, you know, of what happened obviously with the pandemic inflation. But I mean, we have to look at this as a different situation. There are differences and similarities. I mean, it's a different time. You know, we haven't had real price stability fully reestablished yet, and we have to keep that in mind. And you know, we hear that people are very reluctant to take on to allow prices to go up. At the same time, we hear that businesses are intending to pass many of these prices through. So it's hard to say how this is going to work out.
Steve Leisman.
Steve Leisman, CNBC. Thanks
CNBC.
for taking my question, Mr. Chairman. The Bank of Canada, in its last policy statement, said monetary policy cannot offset the impacts of a trade war. What it can and must do is ensure that higher prices do not lead to ongoing inflation. I wonder if that kind of reflects your own sense of prioritization faced with higher prices and weaker growth, that the idea is you have to take care of inflation.
You know, so we have two goals, right? We have maximum employment and price stability.
Yeah,
And we
and
have
you
to
almost said
balance
20,000.
those.
That's a good call out.
You know, there can be situations in which they're in tension, right? And we actually have a provision in our
Will there be
consensus
enough
statement that
follow
says what we should
through?
do in that case. That's a very challenging
Edging.
situation for any central bank, and certainly for us. And so
Calls
what we say
still
that
being
we'll do is
purchased.
We'll look how far each of those two goals is. Each of
Not
those
so
two
much on the
measures is for
SPY
this goal.
though. More so on
And
the
then we'll
Mag
ask
7
how
right now.
long we think it might take to get back to the goal for each of them, and we'll make a judgment because our tools work in one direction. We're either tightening or loosening. So it's a very challenging situation. Let me say, we don't have that situation right now. That's not where the economy is at all. It's also not where the forecast is. I don't know any mainstream forecasts that really show significant problems like that.
New intraday high on both the SPY and the Qs.
Just to follow up, yesterday, the UCLA Anderson forecast said there's high probability of a recession. Where do you stand on whether or not the slowdown you're seeing creates a higher probability or concern that you may have on recession? Thank you.
You know, there's always an unconditional possibility of a recession. it might be broadly in the range of 1 in 4 at any time. If you look back through the years, it could be within 12 months a 1 in 4 chance of a recession. So the question is whether that
really
whether
we always just have a
situation,
25% chance of going into a
those
recession.
possibilities are elevated. I will say this: we don't make such a forecast. If you look at outside forecasts, forecasters have generally raised, a number of them have raised their possibility of a recession.
Here we go.
Somewhat, but still at
20,000 on NQ,
still in the
5,700 incoming on SPX.
If you go back 2 months
since the
people were saying
announcement,
that the likelihood of a recession
we're
was
up
extremely low. So has moved up, but it's
almost
not high.
50 points, like 48 points. So $5 on the SPY. That's crazy.
Hi, thank you, Chris Rugaber at Associated Press. As you know, I guess last night President Trump fired 2 members of the Federal Trade Commission, an independent agency, and this could cause the kind of legal fight about the administration's power to fire independent people. If those firings stand, is that a threat to the Fed's independence? Could he do the same thing to the Fed board?
So I think I did answer that question in this very room some time ago, and I
1
no
in
desire
4
to change
chance
that
for a
answer, and I
recession.
have
That's
nothing
nuts,
new
dude.
for you on that today.
Well, well, maybe I'll have another mulligan. As you know, I wanted to go back to the consumer sentiment, particularly the inflation expectations in the University of Michigan survey. In the summer of 2022, you cited the rise in the long-term inflation expectations in that index as the reason that you went big with a 3/4 point hike. So I know you've talked about all the different measures now, but you seem to not be placing the same weight on that. And so I'm just wondering, are you dismissing that, what we saw last week from the University of Michigan, or does that carry the same weight as it did in the past?
So I mentioned it back then, but in no way did I place a huge weight on it. I think that was a ex post story, but it wasn't the case. That was a preliminary reading, and so is this. And it's also, this is that Michigan, the one you're referring to, the longer term thing. You know, we look at it, we don't dismiss data that we don't like. We force ourselves to look at it, but it is an outlier compared to
Up
market-based, compared to
45
other
points since
survey-based,
this announcement. Damn.
assessments of longer run inflation expectations. So we got to keep that in mind. And I would just say we look at all of them, and that one's kind of an outlier, but you know, nonetheless we take notice of it.
What time is it? All right, it's almost power hour. We're 5 minutes out from power hour.
There's a worry on Wall Street that when you say you want to study the net effect of the fiscal
4 hours
policy
potentially
that
breaking
makes
out on
the
NQ.
economy,
4 hours
that you
potentially
end up
breaking out on
waiting too
ES.
long and be behind the curve in responding to any downturn.
New intraday highs.
Reassure people that you can spot a problem early enough unless you decide to be preemptive.
Yeah, look, we're aware of we're well aware of how things are going to evolve and the time frames and all that. And you know, we will use our tools to foster achievement.
Looks like
of our goals
5,700
the best we
incoming.
can. And of course, we're going to try to be timely with that. For right now, the hard data are pretty solid. We are obviously aware of the soft sentiment data and high uncertainty, and we're watching that carefully. And we think it's a good time for us to
What a
wait for
time!
further
What a
clarity
time to be in the
before we
markets.
Consider adjusting our policy stance.
Do you think it's going to be hard to get clarity in a government by tweet? I mean, do you have a feeling that at some point you actually will have a forecast you can trust?
Yes, I think we will. It's hard to say when that will be. You know, these decisions are going to be made and they're going to be implemented, and then we'll know. At that point, we'll know what the decisions are, and we'll have to make assessments then about the implications for the economy. Those things
Right
will
there.
happen. A lot of
This
them will
is
happen
the
over
next
course
major
of,
open interest
coming
level,
months,
5,700.
certainly over the course of this year, and we'll be adapting as we go.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thank you for taking our questions. At the beginning, you were talking about separating the signal from the noise and tariff inflation from non-tariff inflation.
Tesla's
Can you
getting a
walk us through
pump.
what that
Nvidia's getting a
looked
pump.
like over the
VIX
last
is
couple
below
of months, if
20.
there were specifics from the January meeting to now that helped you make those distinctions?
So when we say
Right now,
separating
you're
signal
actually
from the
seeing
noise,
more of
that's
a
just a way of
Vanna
saying
impact.
things are
Look
highly
at these puts
uncertain,
being closed
and
out
that,
on the Mag
you know,
7.
You're reading about developments. The news is full of developments of tariffs.
More,
being put
that's
on and taken
specific
off
to the
and
Mag
things like
7, though. You're not
That's-
seeing that many
some of that
longer
is
dated puts
noise
being
in the
closed
sense that
out.
it's
These puts
not
are
really
holding
telling
constant
you
on the
anything.
S&P
You're trying
500.
to extract a signal
It is
from that.
unique to
And
the Mag
signal is
7 that you're getting
what's
these
gonna be
puts
the
being
effect
closed.
on economic activity, on inflation, on employment, and all those things. So that's really when we say signal and noise. Sorry, the second
Which
thing was
is probably why you're seeing shit like
or
this.
Similarly for tariff inflation, non-tariff inflation, ways that you're making the distinction.
That's sort of a special case of that. You know, the idea being, and I do think that the first 2 months of this year are a great example. You've got
MSTR
high readings for
305
goods
up
inflation after a
7.5%.
string
Jeez.
of readings that average close to zero, and you have to ask, it's coming during tariffs, but you know, you can't. It's very hard to actually scientifically go back and match up those increases and say, yes, I can prove that that's from tariffs, but it kind of has to be to some extent. Plus noise. There can be idiosyncratic readings in various categories,
Question
which will
is
shortly
this
reverse. So that
region the
happens
end of
too,
the
and that
run?
could be a big piece of it. You know, I think we'll know in a couple of months. We'll know whether those were, you know, where that really was from. But that's another case where I think it's going to be very, very challenging to unpack the inflation that we see over the course of this year and be able to say with confidence how much of that came from inflation and how much of it, from tariffs and how much of it didn't. But that's what we'll be doing. We'll be doing that, and so will everybody else. And we'll
Out
all
of the
be,
past hour,
trying very hard
50
to
minutes
make
of
that
it has
assessment.
just
And,
been
you know,
pump,
I'm sure
pump.
we
There was a
will
little bit
make
of a
lot
breather
progress
right
on that.
before
We
he
already
spoke,
have.
and then he
It's
started
gonna be
talking
challenging.
pump, pump,
Do you have
pump.
a sense yet as to what, in your mind, would make something cross from noise to a signal? What
Here
that
we
threshold
go.
would look like?
Watching
You know, it would depend on what we're
5,700.
talking about. I mean, obviously, you're looking for direct evidence that particular pieces of inflation are or are clearly not caused by tariffs. For example, if it's something that was, you know, in the service sector
Yeah,
that
VIX
was
is
far
below
away
20.
from anything that was
Vols
tariff,
hit by
you might
10%.
think, okay, well, that is, like, frankly, housing services.
The market's
inflation,
clearly very much liking
which,
this
which, by
news.
the way, has been behaving well. You know, which for some time was kind of our problem. Now it's slow, but it's definitely, you know, moving
New
down
intraday
in a very
highs.
good way. It's more now with
Slowly
goods
but
and
surely
services
grinding up to
inflation.
5,700, which would be about another $1 on the SPY, bringing us
taking
pretty
questions,
close
Chair Powell.
to 570 flat.
So consumer
If you're
sentiment
looking for a
has
rough
dipped
equivalent.
dramatically, but you say the economy and the hard data is still solid. What is your message to consumers that clearly disagree and don't feel that strength? Because the hard data they're looking at is their grocery bill.
Okay, so a couple things. The grocery bill is about past inflation, really. There was inflation in 21, 2, and 3, and prices went up. The current level, it's not the change in prices. It's they're unhappy, and they're not
We're
going to
going.
be unhappy that prices went up quite a bit, and they're paying a lot for those things. So I think that is the fundamental fact, and has been for a long time, a couple of years, why people are unhappy with the economy. It's not that the economy is not growing. It's not that inflation is really high. It's not that unemployment.
The bell was
it's
just for
none
new
of those
intraday
things.
highs.
We have 4.1% unemployment. We've got 2% growth.
I'm looking at the
You know,
4 hour
it's a
over
pretty good
here.
economy, but
That's clearly
people are
bullish
unhappy
now.
because of the price
Clearly
level.
bullish.
And we completely understand and accept that.
And just to follow up, why are you still projecting 2 rate cuts this year if your own projections show inflation higher for longer?
I don't
Does
get
mean
that.
You see a slowdown in economic growth as a real threat?
So I think I mean, remember we came into this with, at the December meeting, the median was 2 cuts, the median was. And so you come in and you see, broadly speaking, weaker growth, but higher inflation. And they kind of balance each
Very
other out.
controlled push to the
and
upside.
unemployment is
Not as much
really only a 1%
ASML's
change.
getting a
So
breakout.
there's just not a big change in the forecast. There really isn't. Modest, meaningfully higher growth and meaningfully higher inflation, which call for
Very
different
controlled
responses,
push to
right?
the
So
upside.
They cancel each other out, and people just said, okay, I'm going to stay here. But the second factor is it's so highly uncertain. Is just, we're sitting here thinking, and we obviously are in touch with businesses and households all over the country. We have an extraordinary network of contacts that come in
Still
through
grinding,
reserve
dude.
banks and put in the beige book, and also through contacts at the board. And we get all that, and we do understand that sentiment has fallen off pretty sharply, but economic activity has not yet. And so we're watching carefully.
This high is 5703. So we're coming up to the high from Monday.
Healthy.
This is where it might get a little interesting.
Is quite negative at this time.
It's also key
And
open
that
interest
probably
levels.
has to do with, turmoil
Shout out.
at the beginning of an administration that's making
Slow town,
big
Trev.
changes in areas of policy, and that's probably part of it. I do think the underlying unhappiness people have about the economy, though, is more about the price level.
Getting close to it.
Hi, Victoria Guido with Politico. I wanted to ask, first of all, if you could clarify. You were talking about how tariffs were a good part of the uptick in the inflation forecast, and I was just wondering.
Look at
what
that in the Mag
specifically
7.
refers to. Is that the
Just a
tariffs
shitload
that
of
have already
puts
been put
closed
in
out.
place? Is that anticipating some of the tariffs that might be coming on April 2nd? And then also, if you wouldn't mind, talking a little more about the balance
Someone
sheet
just
decision
dumped their
and
calls
what
right there. They
drove
just
that.
locked it in.
Did that have anything to do with expectations of how
Right
the
here, you
debt
could see
ceiling,
the
raising
delta
debt
drop.
ceiling might affect the reserve supply?
Granted, we
So,
dropped before
in
and
the
still red,
S&P,
but I'm just
you'll
saying
see
that was from
there's
someone
not
locking in
further
their calls.
progress on core inflation this year. We're kind of
We're still looking pretty good.
flatlining, going sideways. We don't ask people to write down how much of this is from tariffs and how much of it is not, but some of it is from tariffs. We know that tariffs are coming in. We know that they're probably already. All forecasters have tariff inflation affecting core PCE inflation, core CPI inflation this year, without exception. I'm not aware of an exception. So it's in there. I can't tell you how much of that it is. In terms of the balance sheet, so yeah, I think, I guess the way I'd say it is, it was the flows in and out of the TGA that got us thinking about it. But as we thought about it, we really came to the view that this was a good time to make the move that we made. And broadly committee that came around.
Here
around
comes
said
the
we
real
would
test,
do
folks.
The same thing we'd already done, which is once I guess
And
in
we
June,
still have all of Power Hour.
was it June, whenever it was, we lowered the pace of QT, and we're just going to do that again. We're going to cut it roughly in half. And the sense of that is, if you're cutting the pace of QT roughly in half, then the runway is probably doubled. Okay, so it's going to be slower for longer. And people really like that. People thought that's a good idea. It's like a plane. You can think of it like a plane coming in for a landing. As we get closer, and we by the way, we still think that reserves are abundant, although you begin to see some of the things we look at begin to react a little bit. But we still think that they're abundant. Now, of course, now the TGA is emptying out, so reserves.
And we got the
higher now,
test.
so you can't really see
All
the
right,
underlying signal.
we're at this
So we
key
came around
level.
to the view,
Now this is
and,
going to be telling.
had a lot of appeal.
So like as we said earlier this morning, above 5650, which we have the nice retest and hold here at 230. We pumped those 50 points directly up.
Isn't sending a signal in
Now
any hidden way.
the question is, will it be able to continue?
Try to
This is
tease
a
out.
big
It's
zone.
not
This is
there.
a
We're
big test.
basically, it's very consistent with our plans and our practices that we've published and that we've followed since we began this, what is a very successful, rundown of the balance sheet. Again, the second time that we've slowed the pace, and we've said that we would stop when we were somewhat above the level we judge as ample. And clearly, we're not at that level yet, but we're going to be approaching it more slowly. It's a common sense kind of a thing, and it had pretty broad appeal, I will say.
Claire Jones, Financial Times. You said in January, Chair Powell, that inflation expectations remained well anchored. Would you still say they remain well anchored today? And just to reiterate the question others have asked,
Dude, they're fucking up with the mics
why
today.
hasn't there been a more radical shift to the policy path today? Thank you.
So when we talk about inflation expectations being well anchored, we're talking about longer run inflation expectations. And they really haven't moved much. I mean, if at all. There's one reading that everyone's focusing on. That
We're
is higher.
almost at
The
that
other
high
survey
from
readings
Monday.
in
It
the
was
marketplace
5703 and a
all show
little bit of
relatively,
change. So if we see
well-anchored
5704, that's a fresh high relative
You
to
would
Monday's
expect
high.
that expectations of inflation over the course of a year would move around because conditions change. And in this case, we have tariffs coming in. We don't know how big, there's so many things we don't know.
Huge
but we
pop.
know there are going to be tariffs.
Look at
They
that.
tend to
All
bring
these
growth
calls
down.
being
They tend to
purchased
bring
for
inflation
later
down.
out, not
And
for
in
this
the first
Friday,
instance.
and all
So-
these puts being
So
closed.
I would say
Mag 7's just
I'm not
ripping it.
dismissing what we're seeing in short-term inflation expectations.
Yeah,
as I
fuck,
mentioned.
man. Look at
Follow
that.
very
Look
carefully.
at all these
But when
calls.
we say
This is all
expectations are,
zero DT stuff.
well anchored, we're really looking
Puts
at,
are completely
longer
flat.
terms, 5-year and out, and there's really
There's
no
zero
story
DT
to
calls
tell
are ripping.
5 years
Yep,
and
we took out that
either
high from
market-based
Monday.
or in surveys. But we'll watch it. I mean, we're not, we're not going to miss any evidence that longer term or medium term inflation expectations are moving.
Marit.
Chair Powell, Neil Irwin with Axios. Treasury Secretary Bessent has observed that a large share of job growth over the last couple of years has been in what he calls government or government-adjacent sectors, healthcare, education. Do you agree that there's some weakness in underlying private job growth, and do you see the composition of job growth as something that has policy implications?
So that has been the case. We talked about that over the course of the last year. There were some good number of months and times when a lot of the job creation was concentrated in, educational institutions, healthcare, state governments, things like that. There were also times when private sector job growth has been
Fucking calls are going nuts.
I mean, they're all jobs, but and remember we're at very low unemployment.
Apple calls popping.
For quite a time. Now.
Microsoft
So
enough.
I think it's a good labor market, but it's
Tesla
something
calls
that we
are
monitor
really
carefully.
popping on this,
From
and
our
the puts are
standpoint,
closing out.
employment is employment. But the elected government is
Nvidia calls are popping,
we don't
puts
have
are being
policies that
closed.
address different kinds of employment.
Amazon.
But the elected government has a different role, and they
Dude,
can,
the Mag
they can
7
have
is just going nuts
Q2
right now.
question. Does the committee envision at some point tapering the MBS runoff as well?
Even Meta's catching a bid. Holy
tapering it.
shit.
I don't know. There's no plan to do that. At a certain point, we'll stop runoff. And we may or may not stop MBS runoff, though, because, we want to stop runoff in net at some point. We haven't made any decisions about that. We want the MBS to roll off our balance sheet. We really strongly desire that. So, but we haven't made any decisions about that. I think we'd look carefully at letting that keep going, but hold the overall size of the balance sheet in, constant at some point, a point that we're not out yet.
Simon Rabinovich with The Economist. Thank you, Chair Powell. Several times today you've said that you feel you're well positioned to wait for greater clarity. At the same time, you could point to quite a few growth risks at the moment. We've seen a stock market that's gone quite wobbly, rapidly cooling housing sales, plunge in confidence surveys. Today, not only did the S&P mark down the growth outlook, 17 of 19 see risks to the downside. So my question is, how confident are you that you're well positioned?
Yeah, we're getting up into positive gamma now. This will get a little bit more
I'm
sticky.
confident that we're well positioned in the sense that we're well positioned to move in the direction we'll need to move.
Yeah, so we ripped super easy because this was negative gamma. So you had market makers supporting the momentum, but things are going to slow down in here.
At a place where we can cut, or we can hold what is clearly a restrictive stance of policy, and that's what I mean. I think that's well positioned. Forecasting right now, forecasting is always very, very hard, and in the current situation, I just think
this is the market since the report. Right here's the report.
And sorry, standing here today, would you be surprised to pivot back towards rate cuts in May?
I think we're not going to be in any hurry to move, and as I mentioned, I think we're well positioned to wait for further clarity, and not in any hurry.
With CNN. Thank you, Chair Powell. The Fed statement released today removed the line that previously said the committee judges that the risks to achieving its employment and inflation goals are roughly in balance. Can you explain the decision to remove that line? Does it mean that you're now more concerned about inflation or about employment?
Actually, it does not mean either of those things. Sometimes with language, it lives its useful life, and then we take it off, and that was the case here. There's really not meant to be any signal here. Over the past year, conveying the sense of the balance of risks was important, that they be in balance or close to being in balance. that was useful as we approached liftoff, if you remember. But we're past that. Or sorry, no.
Looks like we're coming back for this retest of 5,700. This will be pretty telling here.
I actually would say that the more important thing now about risks, and this is in the pages like 10, 11, 12 of the SEP, if you look,
will it hold this
participants
level?
Widely raised their estimate of the risks to of uncertainty, but also of the risks to growth and our employment and inflation mandates. That's a more salient point now than whether they're in balance.
Just on the stock market, the stock market has obviously declined significantly since the Fed last met. Are you concerned at all about some of the market volatility having a real economic impact in terms of hurting business spending or consumer spending, especially among higher income households?
So financial conditions matter to us.
We're all worried
because,
about the
financial
higher
conditions
income
are the main
households.
channel to the real economy through which our policy has its effects. So they're important. But what matters from a Fed standpoint for the macro economy is material changes to overall financial conditions that are persistent, that last for a while, long enough to actually affect economic activity. So that's what we're looking for. I'm not going to opine on the appropriate level of any market, equity, debt, commodities, or anything like that. And I would just point you to the bigger picture again. You know, the real economy, the hard data, are still in reasonably good shape. It's the soft data, it's the surveys that are showing, significant concerns, downside risks, and those kind of things. We don't dismiss that. We're watching it carefully, but, we don't want to get ahead of that. We want to focus on the hard data. If that's going to affect the hard data, we should know it very quickly, and of course we'll understand that. But you don't see that yet.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. As you look to navigate higher inflation and lower growth, the Fed has talked about heeding the lessons from the 1970s. Is the Fed willing to have a recession if it means breaking the back of inflation?
Well, fortunately, we're in a situation where we have seen inflation move down from, higher levels to pretty close to 2%, while the unemployment rate has remained very consistent.
He's evading the question.
4.1%. So we now have inflation coming in from an exogenous source, but the underlying inflationary picture before that was, basically 2.5% inflation, I would say, and 2% growth and 4% unemployment. So that's what we did. That's what together the economy accomplished. So I don't see any reason to think that we're looking at a replay of the 70s or anything like that. Underlying inflation is still running in the twos, with probably a little bit of a pickup associated with tariffs. So I don't think we're facing. I wouldn't say we're in a situation that's remotely comparable to that.
And last month, the idea of a Doge dividend was proposed, which would send $5,000 checks to every taxpayer from Doge savings. President Trump and Elon Musk have supported this. There's reports there could be a bill introduced on Capitol Hill. What impact might that have on household savings and spending in terms of your growth and outlook for inflation?
It's not appropriate for me to speculate on political ideas or fiscal policy for that matter. So I'm gonna pass on that one. Thank you.
Look at that delta on the Mag 7. Jesus.
Hi, Chair Powell. Daniel Avis from Agence France Presse. You mentioned that tariffs are already having at least some impact on inflation. I'm just wondering how you and your colleagues on the FOMC have been thinking about the possibility of tariffs from other countries.
Look at that
especially
rip.
April the 2nd coming up. Was it something you considered during this meeting? Thanks.
So since the very beginning, we've had kind of a placeholder. The staff has a placeholder of a range of possible outcomes from tariffs and from trade policy generally, and they generally assume full retaliation in those, and so that's kind of baked into the numbers. What happens? It will be complicated, and there will be some retaliation and some not, and all that. But ultimately, they're trying to, with the placeholder, give us a broad sense of what this might look like. When we actually know the specifics, we'll be able to have still uncertain, but better informed forecasts. So yes, that's in there.
Last question goes to Jean.
All right, last question.
Hi, Chair Powell. Jean Young with M&I Market News.
had a couple questions on the balance sheet change that you made. So the minutes had initially described your discussion on slowing QT as temporary until the debt ceiling is resolved. But from what you said earlier, it doesn't sound like there's a desire to kind of regain the pace of QT that we have at the moment after the debt ceiling is resolved. Is that the case?
Yeah, so we looked at pausing and we looked at slowing, and really people came together very strongly behind slowing, not pausing, for a variety of reasons. And so people really came to be, pretty strongly in favor of this move. Slows down the path and probably lengthens it, doubles it effectively by slowing by half. That people thought that's a good place to be. It'll help us assure that this path is a smooth one as we get closer and closer to that. So that's how that came about.
Well, I guess my question is more, was that meant to be a temporary measure during the debt ceiling episode, or?
It was the TGA flows, Treasury General Account
What?
flows, that got us thinking about this. But the more we
Delta's
thought about
dropping
it, we came
now.
around to this. And it is, yes, it was provoked.
Are they going to dump this? Look
Discussion
at
was provoked
Delta's
by
been
that.
dropping
What we
since
came up with, though,
310.
was broader than that and different than that. It does address that issue, but it really is.
Someone's
also-
unloading.
It fits in really nicely with our
And now
principles
they're
and our
buying
plans and
puts.
the things we've done before and the things we said we would do. So that's why pretty strong support. I just say it's
See this
nothing
retest
to
here.
do
Let's
with
see if this
monetary
holds.
policy, nothing to do with the size of the balance sheet. It's just kind of a common sense adjustment as you get closer and closer. Let's slow down a little bit again, and that way we'll be more and more confident that we're getting where we need to get. You can take our time getting there. We're shrinking the balance sheet every month, and we think it was a good play, and as I mentioned, well supported. Thanks very much.
All right, that's all she wrote. We're now getting the, second test of 5,700. We ripped up to it, danced around, had like the over-exuberant push, pulled back, pumped again, and now we're at that retest. And the retest happens to be, here, let me clean this up a little bit. I want to explain everything that happened. Very interesting, honestly. All right, so let me go out to the 1 minute here. So upon the FOMC Fed interest rate decision right here, at first we were slightly down, then it popped, then it pulled back, didn't pull back the full way. We popped again, pulled back into the start of his talk at 2:30. And then from the talk until now, obviously we ripped, and we just ripped and ripped and ripped. And it was right around 3:10 that we stopped. And the reason we stopped, this one's pretty evident. That's exactly when the options flow, why is that not loading? Right here. You can see that's exactly where the options flow turned off. Basically, so the bullishness right there, it peaked at 309 and the market peaked at 310. That is no surprise. So the delta was ripping. On the S&P 500, it was only call driven. The puts have been flat this entire time and calls were getting driven up. And you can see there was a good amount. The fact that it was so tightly coupled, it was just the zero DTE movement. And then the fact that we got a little bit more of this delta, that is longer duration calls for sure. But what's interesting about the entire move is the puts did not fold. The puts held this entire time. The puts did not ditch, which should really stand out to everyone. But if you look at what's happening in the world of the Mag 7, the combo of Apple, Amazon, Google, Meta, Microsoft, NVIDIA, and Tesla, something different happened. The calls were ripping. People were buying longer dated calls. They were buying calls for this Friday, but also puts were getting closed. Obviously, very different than what we saw in the S&P 500. We might as well check the NASDAQ. The NASDAQ was kind of interesting too. No one really touched puts, and that now people are buying puts right now. They are opening puts up as they're ditching these calls. Is this going to be a fake out? When we see setups like this, every fake out setup does look like this, but everything that looks like this doesn't end up becoming a fake out. If something were to become a fake out, it would have to start looking like this. But there are counterexamples where things like this, and not all of them lead to being fake outs, if that makes sense. Because you're getting the zero DTE rip. Zero DT puts weren't touched, and now people are opening up longer duration puts right now. As soon as he stopped talking, well, really, as soon as the turn at 310, which maybe 10 minutes before he stopped talking, 5 minutes before he stopped talking, people started to get more aggressive with longer duration puts. That's interesting. These calls are now flat on the Mag 7. Actually, everything's now flat on the Mag 7. The NASDAQ is dropping here. They ran this up till 310. So what I was going to tell you is if we break above 5,700, check. Okay, I like that for the bull case, but I would like it a lot more if we closed above 5,700. So I think where we close today is going to be very, very telling. So today in the SPY, the Qs, SPX, NDX, we broke the high from Monday's session, maybe suggesting a technical turnaround. But as of now, and granted, we still do have 35 minutes to go, not holding. So I would be much more convinced to go long into this if we held above it. But clearly, as of right now, we are not holding that particular moment. But there's still a decent amount of time left in the day. I'm just wondering, do these large players really have the balls to run this back down to 566, run it back down to 480 by the end of the day? Like, because it's a zero DTE phenomenon. What just happened? Look at, like, I'm showing you in real time that options are getting dumped. And what's weird about what's getting dumped is the zero DTE, which inherently has to expire today, ran it up. They're starting to collect. But for what, like, look at this giant spike in volume right at 310. People are buying longer duration puts. They waited for him to stop talking, and now there's aggressive put buying. More specifically, can you guys see this? Let me see if I could give you the exact strike. So this is open interest, but it's longer duration. Open interest, volume, expiration. What is today? Today is Wednesday, Thursday, Friday. Okay, so let's do this. And let's look in the past 15 minutes. Okay, so that's today, dude. In the past, people are buying put. No fucking way. Are they seriously doing that? In the past 15 minutes, people have been buying puts for all the way down at 5,515. All the way down. Dude, what do they know that we don't know? And they're also buying puts at 5,480 for Friday. This is for tomorrow, Thursday. This is for Friday. Like, this is for today, but today's almost over, so I'm focusing more down here. There's this, look at right now. Someone just bought the 5,550s. Like, in real time, we were sitting here. 5,550s. We just saw that spike pop up. 1,000 contracts. 1,000 at 5,515. Jesus. What are they seeing that we're not, dude? I mean, that's a ballsy play. Granted, they're dirt cheap right now, so they don't have that much risk. But interesting. That's like, I'm just fascinated by this right here. They waited for him to talk and like, we need longer duration puts and we need them now. And then of course we just have these calls getting crushed. No way. Are they really gonna be that fucking crazy and drop this back down to 566 today? Drop the Qs back down to 480? Just like, so why we move so much, we had that dumb fuck in here that was trying to tell you guys about positive gamma being bullish. Remember, positive gamma and negative gamma, for anyone who knows what they're talking about, they're not associated with being bullish or bearish. If you have negative gamma, which is red, that means that whatever way you're moving, you're most likely going to keep moving. And then positive gamma is more like quicksand of like, oh, you run into it and you just really slow down, and it's more of a mean reverting thing. So I know there was someone in chat before, and trust me, they just don't know what the fuck they're talking about. It's honestly embarrassing. But right here, is anyone surprised that we ran up to 5,700, the key gamma level that we talked about? We're getting to positive gamma, and then it starts to turn. That was the perfect place to take your profits. I'm actually surprised it overshot as much as it did. If I were taking that trade, which I didn't, I wish I did, I would have taken my profits right here at 306, like right when we got into it. I didn't expect it to go another 10 points. And then by the time we put in the lower high right here, we started to come over. You clearly got your final warning shot to get out at 317. But you shouldn't be surprised. This is negative gamma. When we started moving, here, let me zoom in more. This is negative gamma. So whichever way you move a lot. Look exactly where it stopped. It stopped where we went from negative gamma to positive gamma, because positive gamma is mean reverting. And then we're back in negative gamma, which means if we get moving this way, we can really get moving this way. It cuts both directions. Negative gamma can be very bullish or very bearish. It's just telling you buckle up for some moves, because whatever direction you're going, the market makers are going to assist that move. So I mean, we literally might be talking about 566 and 480 again by the end of this. That's fucking nuts. That's nuts. Do I have the balls to add to this? Oh, I'm already in pretty fucking deep on this. Okay, sometimes you just got to put your fucking money where your mouth is. Sometimes you got to put your money where your mouth is. All right, maybe I could lower my average enough to give myself a fighting chance here if this is fully faded all the way back down. And I'm not touching any zero DTs, like I said at the start of today's show, and really even the start of today. On days like this, I really don't like zero DTs. I'm not a fan of zero DTs at all. I find it's a lot more luck than anything else. What I'm changing right now is my swing positions. I'm just adding a little bit to my swing positions. Obviously, I told you guys I was swinging puts into this, and then I was just waiting that opportunity to either ditch and just admit I was wrong or lower my price, and that's exactly what I did. So just lowering the price on some of these because, once again, tying this all together, I see we're in negative gamma. If we get moving, we can really get moving, and you can see from this heat map that the darker the red it is, the more negative gamma, things speed up. You're actually going to get faster and faster. So right here was the slowest movement or the slowest moment. And this is actually where market makers stopped their buying because we got into positive gamma. And right here now we're dipping. And if we really start dipping, which there's not much time left, there's only 30 minutes left. I guess we've seen crazier things, but if we start dipping, it'll just get faster and faster and faster because of just how the gamma's set up. What I do, I guess, want to share with all of you, and I do find this very interesting, actually. Here, let me go back to this so you could see it. NVIDIA's getting hit. Tesla's getting hit. What the fuck is going on here? This is crazy, dude. What I am seeing is an interesting shift for tomorrow. So let me reload this just so I can give you guys the most recent data so everyone can feel a little bit more comfortable. So when we started out this week at market open on Monday, Tuesday, Wednesday, Thursday, all of them were call dominated on the chain and they were positive gamma. And then Friday was put dominated, negative gamma. At some point in between Monday and Tuesday, it switched to, once again, for the entire week, it was put dominated, negative gamma. As of right now, just so you know, not talking about today or this week, the entire chain, the whole chain right now, it is put dominated, negative gamma. If we look at just today, that actually really doesn't matter because today's about to be over. So let's just look at tomorrow. Tomorrow has once again shifted from being bearish to being bullish. As of this exact moment, it is slightly call dominated with the biggest interest at 5,740. Wait, like 30 points higher than when we went today. That's like the bull interest side. And then the bear interest side is down at 5,650, which was that key open interest level. So once again, 5,740 and 5,650. And I'm referring to the SPX. So all the way up here and all the way down here. That is just for tomorrow. And then just looking at Friday, which is the big monthly, quarterly quad witching type of a day, it is a huge spread. It is a choppy mess between 5,800, an entire 100 points above this, all the way down to, surprise, 5,650. So it's kind of saying anything in that range is just no man's land, which it's kind of normal. It's frustrating to trade it, but that is kind of normal with like such important events. Wow. They are really looking for something fucking nuts to happen here. But once again, that is put dominated. So as of right now, we have 29 minutes left in the day. It was call dominated because of all this zero DT call buying that we saw. Hang on, let me switch this back over. I want to see what's going on. Calls are now flat. Oh, puts are getting closed out a little bit of a reprieve. I'm just so fascinated by this aggressive put buying that started at 310. Anyway, because of all this call buying that you can see kind of starting at 1208, really picking up at 220. That kicked today to be call dominated. And it actually, at some point, people bought enough calls to make tomorrow call dominated. Now, granted, it's not dominant. It is dominated, as in there's more calls and more call related gamma in the system for tomorrow, but it only has a slight upper hand. And then Friday, clearly put dominated with a very wide range, with a huge gamma implication at 5,650. 5,650. So it seems like all roads lead back to this right here. If we can hold above this level, 5,650, that I would say is representing bullish strength and true bullish dominance. But on the flip side, that would make this whole situation a fake out breakout if we get pushed back down below there. So it's 5,650 on SPX, and on SPY, that is roughly 565. Not exactly, but it's like close enough in that region if you're looking for it. But if you want to know, well, it's pretty much, if you find the 204 closing candle on the minute chart, it's pretty much that exact value. So if you want the SPY equivalent, just go to the 204 Eastern closing channel, East time, ET, and that'll be roughly it. I mean, it's what? 204. Yeah, it's 564.50 is roughly the level. So it's kind of like this dip zone in here, if you're looking for that rough equivalent. I'm kind of the opinion that today is pretty much shot. I mean, we're seeing a lot of movement in the SPX due to the 0D DTE. You could, I mean, oh, and now it's actually going crazy again. So some of these puts being closed, the 0 DTEs. So basically people that had 0 DTs are just admitting they're wrong, and they're 0 DT puts, that is, and they're saying I'm closing this out, when in reality, the fact that this gap from 310 to 330, the fact that this gap widened means that people got more aggressive in their longer duration puts, which I would have not have expected with such a bounce, but it is obviously what we got. Fucking crazy. That's crazy. The NASDAQ looking kind of like the SPY, where we got the 0 DT pop up until 310, and then it pretty much puts started to get purchased right after, and now we're just kind of in no man's land. But the reason we're seeing a bit of strength is because of this right here. Really getting going at 220. People went hog fucking wild for Mag 7 calls. And granted, there was some stuff for this Friday, but it was more so longer dated. It's really this movement from 242, if you will. Like it just got crazy. It got ravenous. We just ripped. And then a longer duration, some of them were for this Friday, and it actually forced a lot of puts to get out of their position. So you really had the delta just like ripping up. And when the delta rips up, you're going to get price going up. That's fascinating. Also, no surprise where we ended, like the height of today's run. We got right barely into this positive gamma territory, slightly overshooting the most important gamma level currently on the chart. And then we just got smacked. And the reason we got smacked was it wasn't really bears stepping in. Yeah, some bears did step in, but if anything, it was more of the combination of bears stepping in and those 0 DTE call buyers locking in their profit. I cannot emphasize this enough. The call buyers were not a longer duration thing. The people who bought these calls were playing today. They were playing exclusively today. So will they continue with that strength tomorrow? I mean, your guess is as good as mine. I was looking to see if they would knock it back down to 566. We got to 566.61, and I was looking on the Qs to knock it back down to 480, and we got to 480.35. So there's still a little bit of time left in the day. At this point, I might as well just hang out with all of you guys, and we're going to see how this plays out. It looks like things are very much simmering down at this point. We're not getting as much follow through, and we're also just not seeing as much just craziness in the options market right now. We're seeing a little bit of a drill. Even that, it's kind of gone flat since 330. 336, we know people are going to get their positions closed out on the retail brokerages if they don't have all the margin that they need for the cash settled products. So we're kind of going through that right now. All these retail brokers balancing out their books, and generally you actually see more of a movement. But I guess we already had so much of a movement that maybe vol is calming down. Interesting to see if the VIX is going to close above or below 20. So in this whole situation, I mean, you can see it right here at 14 o'clock, right when we got the Fed interest rate decision. Vol dropped right away, tried to hold, and then it dropped even more when Jerome Powell, this entire drop off in vol was from Jerome Powell speaking. And when he stopped speaking is pretty much when vol started to pick back up. Interesting. I'm not really in love with my positions right now, if I'm going to be honest with you. I would have literally, like, if we close, and we still could, if we close above 5,700, I might just ditch it today. But other than that, I'm going to give it a shot because the overall trend, really focusing on the March OPEX, which is not tomorrow, it's the next day, that is bearish. And I don't really want to ditch my current bearish positions when I know quadruple witching as of now is setting up to be bearish. Someone just asked, what is quadruple witching? Quadruple witching is just in a date alignment where there's 4 major types of contracts, 2 futures and 2 equities, where they all just expire on the same day. So it just causes a lot of volatility within the market because there's a bunch of money that has to be repositioned because the contracts are expiring. So it's not bullish, it's not bearish. There's been a lot of studies done on it of like, oh, is it bullish? Is it bearish? It's not. It's just a big movement day. Roughly 50% of them end up being bullish. Roughly 50% of them end up being bearish. But it is this Friday. And in your mind, when you hear quadruple witching, it truly is just a high volatility day. And why it's a high volatility day is because a lot of money has to be shifted around. So that's what quadruple witching is. There is such thing as double witching. There is such thing as triple witching. A lot of times people confuse triple witching and quadruple witching. They say triple witching when they really mean quadruple witching. So if like this Friday, you're going to read headlines that like, oh, it's triple witching. I don't know who taught them. I don't know where they got it from or anything like that. But this Friday, if you read triple witching, it really is just quadruple witching. And then, of course, the name itself just comes from how many different types of contracts are expiring. So it just has to do with that date alignment. Poll for what level Matt's puts are at. Ha, 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 ha. I mean, they're down right now, obviously. Did you seriously not know that? The Match Tries quadruple witching video is the best ever. Dude, hell yeah. I think that's where I peaked as a content creator. We're now doing nothing. So we had nice movements, nice rip up. The conversation ended like literally a minute or two within this, and then he stopped talking, and that's exactly where we started to get faded. This little push to the downside was all the 0DT call buyers just locking in their gains, and basically it was a game of hot potato, and like the slower you were to react to this, obviously the less profit you got. And then from here, this is just kind of whatever bullshit trades, I guess, people potentially setting up for tomorrow or something like that. The big thing that I'm seeing is actually, I don't know how I would personally handle that because I still have to get through tomorrow. Like I want to carry my puts because I'm feeling that confident about March OPEX, but I'm admitting tomorrow is now setting up to favor the calls, starting to favor the bulls. So tomorrow might be a rough day for your boy where I just might have to like white knuckle through it because the day I'm really attempting to play is Friday. And I'm already in these positions right now, even though tomorrow it has shifted. It's officially shifted from being bearish to being bullish tomorrow. So I guess I could hedge it out. I could, if I wanted to, get some calls tomorrow and kind of box the position. That's like one opportunity. I could get calls, ride them for the day, close them at the end of the day, and then literally just use that as like a delta difference on my put. So like maybe that's something I'll do. I'm not going to be doing anything today. I think I have no idea, and I don't think anyone does, of what the overnight situation is going to be bringing. So I'm not by any means tempted to do something right now. But tomorrow, just in case we get a ride tomorrow, I might need to ride that. It's in the equities world, it would be called boxing your position. It's not necessarily the same thing in the world of options by any means. If anything, I don't even know if it has a name of what I would have to pull off. Some weird long calendar straddle, dumb, just basically a dumb position. But I might have to do that basically to hedge a little bit. But I'll revisit that, and we could easily talk about it in the morning. I'll happily let you know if I decide to do it, but it's not going to be happening today. because I have no idea what the final 18 minutes here are going to bring. And I also have no idea what the overnight situation is going to be bringing. The hell is this guy? We have it. Matt, do you need a bodyguard for your new Tesla? I don't have a Tesla, but I am seeing that a lot of them are getting card and stuff or keyed, and then they're trying to put that on like some list of like, if you do it, are you technically a terrorist? I was just listening to the White House press conference right before this, and I didn't realize that the situation had gotten that bad that people were keying so many cars, and now they might be considered terrorists for doing so. So we'll see. It's going down. Puts are fine. I think it's also going down. I think the system has one more flush in it related to all of the basically what's going on the option chain for this Friday and also for next Friday. So I'm feeling good about that. But for tomorrow, it's kind of like the day before thing. How are people going to react to Powell? I am seeing that the option chain exclusively for tomorrow went from being bearish to being bullish. So it might be a little bit of a white knuckle situation for your boy. A little bit of a white knuckle situation. Yeah, we got this little pullback. This little pullback here was just these call buyers locking in. They're just smashing the cash register. I don't blame them. I don't blame them. Right here, we pulled back. We dipped at exactly 330 when we know the retail brokers are causing people. And we're at the point now where calls are going flat and puts are going flat. I guess, crazy stuff could happen in the last 15 minutes. It definitely, Mag 7, dude, this is where the strength is coming from, is the fucking Mag 7 is nonstop. That delta just ripped like no other. And it's not specifically for this Friday. Yes, of course, some of this Friday went crazy, but it's more so longer duration. People must have been using this event of like, okay, cool, we'll buy April monthlies, May monthlies, whatever it is. They just started buying like no other. Like, look at that rip. Look at that. And the VIX is coming down with it. Jesus, dude. Jesus. We're at 5,700. How am I going to do it? I guess what I could do, another option, is wait to see how we open tomorrow. If I need to dump my positions right in the morning, that's fine. And then I could always re-enter all of them on Friday if I want to. And if not, if the situation's still positive, just never have to re-enter. Do you think next week is bearish? I think a lot of it's going to have to depend on how the quad witching day goes. Like, most of my current trade setup and like thesis of the whole situation is hyper dependent on quad witching, because I want to see where they all roll their positions too. So I see that there's people trying to make conjectures of like next week and the week after, and I honestly don't know how they do it when we just don't know where the new positioning is. Like, the major positioning we know right now, it is concluding this Friday. So you kind of have to wait to see where it goes from there. I guess other people are throwing out thoughts, and I don't know what it's being necessarily based on. But what I could tell you is I think the bottom is somewhere between this Friday and really early April. Like, I think somewhere between March OPEX and the start of April, which is referring to like the whole Trump tariff thing, somewhere in that week and a half period, I think is roughly where that bottom is going to be. And then from there, I guess I should be like clear. I think that's going to be the bottom. And then we just have a lights out, crazy, exciting, bullish April. That's kind of like my current going base case. So even though I'm currently holding a bearish position, my time frame is about a week and a half. I don't think it's going to be sustained past that. I think there's too many things in the system right now that could easily just cause this to get ripping. So for example, the official ceasefire agreement between Russia and Ukraine, the reciprocal tariffs becoming non-existent, and we come to a better trade agreement with our major trading partners, a super aggressive positive role in the JP Morgan position, a super positive aggressive role in the on quad witching to the next quad witching to the next quarterlies, even to the monthly. So the April monthlies, that is. So I think there's right now, if one or two of these things align, it could like just really get it going. And what I'd be looking for at that point is referred to as a Vanna rally, VANNA. And that's just the phenomena of a bunch of puts being closed out as volatility collapses. That means that market makers just don't have to hedge as much. So they get rid of their shorts, they buy back, it goes up, people get excited, they YOLO into calls, the delta rises more, the market makers start to hedge by buying the underlying, pushing up more, causing volatility to collapse. And it becomes a very like clearly a positive feedback loop. So that's what I'm looking for of why I keep predicting a lights out April is really I look for just like a Vanna rally to take us to the moon. So that's kind of what I personally believe is the highest probability pathway. But remember, when it comes to trading, every single avenue is a certain probability. There's ones that are higher and lower probability, but this game of trading should never be thought of as like, oh, okay, like this is what's going to happen. I'm confident. It's just the game of probabilities. That's all it is. It's like a tree root system, and each particular pathway has an associated probability with it. So you might want to identify the top 2 or 3 most popular or highest probability pathways, and then just look to see if they're playing out. But with that being said, the reason I'm stating it like in the way that I am is because sometimes like the crazy low probability thing happens. Like that is still possible. It's not likely, but it's still statistically possible. So you kind of want to be, that's why you should always have like risk, just because, hey, maybe you were preparing for the low likelihood thing and the high likely thing happened, or vice versa, this, that, the other. Maybe there's a whole new random announcement and then something that you thought wasn't likely becomes like the most likely. There's a gazillion different examples of like why you still always need to be protecting your risk. But as of this moment in time, I personally believe the highest probability pathway is an additional sell-off, with the bottom being put in somewhere between March OPEX, which is this Friday, and the start of April. And whatever that low point is, I think that's the official dip to be bought. So that's what I'm looking for. Like I said, it's not the only pathway of where this market could go, but I do believe it's the highest probability pathway. And I think it could get really, really exciting into next month if we see what I'm referring to as a Vanna rally, which feel free to whatever, Google it, ask ChatGPT. But what you need to know there is it happens after dramatic sell-offs, and then there's a lot of puts in the system, and then the puts get closed out and vol collapses, and you just get these huge rips to the upside. The last time we saw one like that was actually August. So if you look into early August, the pop back, actually I could just show you right now on my screen, SPX daily. The last time we had a Vanna rally was right here. This was a Vanna rally. Right here. This was a Vanna rally. So what happened? This was the whole yen carry trade blowing up, and we all overnight became experts on the currency trades. But anyway, we puke, and then somewhere in between the Tuesday, August 6th, and Thursday, August 8th, somewhere in here, a bunch of puts started to get closed. Puts closed, volatility started to drop, and guess what? 1, 2, 3, 4, 5, 6, 7, 8 days in a row of just green ripping. SPX went from 5253 all the way up to 5,600. We went up 350 points with no red days. This is the last time we had a Vanna rally. So I just want to point that out. I'm not saying that this is definitively going to happen again, but you bet your butt I'll be looking for it, because if you're on the right side of that trade, you can make a shitload of money. Speaking of being on the right side of the trade, I'm seeing it drop. Dude, are they going to drop it to 566 and 480 like I was calling out? How much time do we have, Liz? The 350 bots just hit. The bots that run at 350, those are the ones that are reacting to the market on close orders. Obviously, it was a bit bearish there. Getting clocked right here. We just started to sell. But we didn't take out that recent low yet. We didn't take out 73. So I'm going to be holding my position just because we're not closing above 5,700 unless the next 9 minutes are crazy. I have to admit it. I don't like it. I wish I waited until, I don't know, 3:10 to create my current position. But for all I know, when this event came out at 2 p.m., we could have plummeted from there. So like, you have to be a little bit cognizant of like what's in your control and what's out of your control. What's in your control is reasonable risk setups and riding the trend and reading the option chain properly and that type of stuff. But when it comes to a binary event, I mean, you don't know which way it's going to go. As easily as this broke to the upside, it could easily break to the downside. There could be reversals when he's talking. We could push large one day and then the very next day completely fade it. Those are the types of things that are in more of the realm of prediction. And as much as you want to predict, remember, there's no such thing as a guarantee. The high probability things happen often because there's a high probability, of course. But then there's all those times that we have the weird low probability things playing out as well. So where are we at? We're about 7 minutes out. We're not holding 5,700. We got the fake out breakout from the high on Monday, and we're fading a little bit. But as much as we're not getting the breakout, we're also not getting the breakdown. And the breakdown would be 5,650. So we are pretty much officially in no man's land right now. Almost smack dab in the middle of no man's land, which makes it very difficult for the bulls or the bears. We aren't getting that official breakout and rally, and we're also not getting the breakdown proving that this entire thing was a fake out. So we're literally in the ghost town. We're just waiting. Of course, from an intraday basis, the recapture of 5,650 in this pump, that was a pretty obvious play. That's exactly why we had these levels laid out. But once again, that's more on the 0 DT basis. For like swing trading, right where we're seemingly getting pinned to right now, you don't really know. We didn't push hard enough and get the close where we're like, oh, the bulls are in control. But we also didn't get smacked hard enough that we're saying, oh, the bears are still in control, which is kind of being represented in, like, it is being represented in the option chain right now. Tomorrow is leaning kind of awkwardly slightly bullish, and then Friday's still bearish, but not as bearish as it was before all this started. So it's going to be one of those days where you're like up in the middle of the night checking the futures market, and in reality you can't do anything, so you're just going to wait for market open tomorrow, and you're going to pray it gaps in your favor. And then not only does it gap in your favor, whether you're bullish or bearish, you're going to hope it keeps continuing that way. But right here, we are almost perfectly getting pinned to like not knowing who's in control. So classic market wanting to create as much pain for everyone involved as possible. But would you expect anything else? Would you expect anything else? Buy MSTR and chill. Leaps too. Depends. Depends on what time frame you're talking about. If you're talking about April, May, I agree. If you're talking about something out for 2026, I don't agree at all on MSTR leaps. So when you're saying buy MSTR and chill leaps too, it depends. If you're saying buy and just sit on MSTR stock, I also think that's a pretty weak play. I think there's more capital efficient things you could be doing. But I could see things like MSTR, Tesla, Costco, ASML, all doing pretty well into April and May. Can you invest in Depends, like the diapers? You can invest in Procter & Gamble, which I believe probably does a lot of diaper sales. Yep. Dude, they're literally going to close us right halfway in between the key zones just to make life shitty. All right. Well, it looks like my Q prediction is almost about to be right of saying, are they going to run it back down to 480? But my SPY prediction, not so much. It looks like I'm off by a buckaroo there. How much time is left? 3 minutes, 4 minutes, something like that. VIX is, dude, are they really going to put it right at 20 where it just tells us no one knows what the fuck's going on? VIX holding 20 where it's low, but not that low. And we got the break, but are they going to close us just above yesterday's high? That's what I'm saying is like they pushed us all the way up to Monday's high, and now they're running us all back to yesterday's high. Like where we were already here. The level we're at, we're pretty much, that's where we were at noon today. Oh man, I'm looking at the VIX right here at 20. What are they doing to us? They're toying with our emotions, folks. They're toying with our emotions. do I see? I'm just trying to see if I see any other major changes that I want to let you know about, and I'm not seeing it. The big change that I noticed was tomorrow's expiration went from slightly bearish to slightly bullish. Friday's expiration went from mega bearish to less bearish. And the most fascinating thing that I'm seeing on this chart is as soon as he stopped speaking, that's when people started to buy longer dated pits. And on SPX, when I say longer dated, anything past today. The light blue is today's puts, but right here, you could see that giant volume spike. And that's exactly when people started to get into puts. And then in the aggregate, some were closed out. And then right now, as we're talking, some more are being like kind of scooped up. And some of these longer duration calls are being closed out right there as well. Dude, brutal. Tomorrow is going to be a bitch of a trading day. It's just already out there. It's already out there in the ether. Tomorrow, we're going to see. We're going to see. Market overreacted due to gamma rally. You would be fine with puts. Yeah, it could be a gamma rally overreaction. Like, without a doubt, that is a very... Whoa, what the fuck? Yeah, we ran right... Hang on, this can't be right. Did we just pop out of nowhere? Mine stopped updating. But yeah, this was the negative gamma. This was the positive gamma. We ran right up, overreaction as you're standing, and got smacked right in the positive gamma. And now we're just kind of chilling here. But mine is not, this is not the most recent data because as I can see, we're trading all the way down at 5675, which truly is no man's land. What a fucking joke this is. I don't like the market. It's rigged. This game is rigged. I hate this casino. I hate this casino. I love it if I'm winning at the casino, but on days like today, it's more of a hate-hate relationship. It hates me. I hate it. Just choppy bullshit day. Enough to fuck over everyone. The put buyers clearly fucked over, but giving them like a little glimmer of hope right now. And then the call buyers were crushing it. But then if you overstayed your welcome, you just got crushed. So everyone got screwed. It is. Do you use Trade for Apex accounts? Nope. I use Rhythmic. No, sir. No, sir. No, sir. Babo. That's pretty much it. All right. Before I let you guys go, because the market's about to go dingity ding, ding, ding. Folks, any last second questions, comments, concerns, anything like that? We have literally 20 seconds until the casino closes. 20 seconds until the world's largest casino closes. What's on your minds? We talked about yesterday. We talked about quad witching on Friday. There are a couple earnings tomorrow that you might care about. Trying to think of anything else. We're going to be streaming tomorrow, 9 a.m. bright and early. I hope to see you there. Where did I get the sweet goggles from? I don't know. Just one of the costume packages, I think, off of Amazon. I don't know at the moment. Take an Epsom salt bath tonight. Probably need it. Probably need it after this day. But there we go. Dingity, ding, ding, ding. The world's largest casino is officially closed. You don't have to go home, but you can't stay here. Technically, there are some back rooms where all the cool people in the casino can hang out. There is some post-market trading if that's something that does interest you. But for the general public, the casino is officially closed. So I think that's important for everyone to know. It is officially closed. Made 200% today. Congrats. Okay, who made a killing? You know, we haven't done one of these in a hot minute. This is your time to brag. This is your time to brag. Who crushed it? I'm reading chat. Right now we have someone making 200%. Who else made a killing? I really didn't. Well, I guess I made 24, 25K, maybe 28K. Well, I don't know. I don't know what I made on Rhythmic, but I made something with Rhythmic and Vanquish and Take Profit and all that stuff. So I was able to make a good 28K there, but that's the only trade I locked in. I didn't really do anything because I knew it was FOMC day. Looking to get spot gamma sub. Do I need alpha or pro sufficient? Mostly trade ES futures. I use alpha. If you want the hero flow, you have to have alpha. I really think it's worth it. And if you're trading ES futures, as long as it helps you get 5 extra points in a month, it's paying for itself. So I think it's completely worth it. I made $1,000 on the way up. Dallas Jackman crushing it. 240%, $20. Loaded a solid inverse position, 30% on portfolio. As profitable, not that much. Hey, winning is winning. 3.4%, winning's winning. I made a killing by suicide. Wow, that turned quick. 580. All right, we got some winners. Etsy puts made 40, 42%, 12K since lunch. 800. Got my first Apex account today. 300K, up 5K, sick. 52%. Made 1K in the AM session. 650 on ES and NQ, was down 43%. Held till J Powell closed, out 134. Nice, dude. Made a couple hundred swing trade. All right, you guys are crushing it. Did better than me today, or at least better than I'm feeling, but we'll see how I have to manage these puts later on. All right, folks, that's what I have for you. We're going to be streaming once again tomorrow morning, 9 a.m., bright and early. I appreciate you stopping by. I appreciate the good vibes. And the way this is setting up, we are definitely setting up for a pretty crazy remainder of the week. So in the morning, I'll do the breakdown of all the lines I care about, the price levels I care about. I'll let you know about the options. We'll do the full breakdown tomorrow. On top of that, pay attention to any Russia, Ukraine, Zelensky, Putin, Trump news that might be coming out tonight. Any tariff news. Like I said, we have a couple earnings, but I don't think the biggest ones. And then really it's going to get wild on Friday, where it's not only Payday Friday, but obviously it's also going to be just quadruple witching, which is going to be nuts. So hope to see you there. Enjoy your evening. Be safe. If not, have fun. I'll catch you guys on the flippity flip. Have a good one. Peace.